Push as well to bigger and bigger groups, and they've been part of that narrative. Hargreaves Lansdown, interestingly enough, yesterday was up by 14% on the back of all the takeover stories around that sector yesterday. So that was fascinating. National Grid, a little bit softer. What are we going to see this morning, I think, is an interesting question. Chip stocks. NVIDIA did really well yesterday, but it may be actually that what we see this morning is some of the chip stocks here in Europe. Now, technology has been really strong recently, but some of the chip stocks today, you may see some weakness in that space here this morning, this Friday. Remember, we are also going into a long weekend here in the UK. That's a factor to think about just in terms of the flow narrative and the risk narrative. So it's Friday the 24th of May. We are open. Let's see what exactly happens here in Europe this morning to get an idea of what is going on. I already see AP Moller Maersk a little stronger this morning, which I think is interesting. Mondi, we were mentioning just a moment ago with Joe. That stock looks like it's solid as well. I'm interested to see how National Grid trades on day two as a result of that heavily discounted rights issue. Could see some softness there again as well.
Yeah, that was certainly a story of yesterday, wasn't it? Real explanation of why we saw underperformance for some of the session from the London market. Quite a few upgrades and downgrades, and Joe talked to us about some of them, but I'm seeing Ryanair in focus on that front, plenty of Fortum in focus on that front, UK, home builders, all of that could move markets, so we watch Persimmon and Barclay as a result of those.
We should also talk about this from a sectoral perspective. You are seeing some of the commodities names on the back foot here when you look at the FTSE 100 in particular, Shell, Glencore, BP, all some of your biggest weights when you look at the index as well. Rio Tinto, for example, some of the metals companies as well, weighing the entire thing. National Grid, to your point, one of your biggest, in terms of index contribution, one of your biggest weights in those opening trades, down 9% this morning.
So over the last 2 days, it gapped lower yesterday morning on the back of the rights issue news, and it's gapped slightly lower again this morning, though it's still currently trading kind of above the session lows that we saw yesterday, but it's still down by 12% on a kind of Wednesday, Thursday, Friday basis. So it's interesting to see that story is continuing this morning. We haven't talked a lot about the commodities, and I think that's a really interesting story. So oil prices have been down really sharply this week. That's been a theme that we've had to watch out for. It's interesting going into OPEC. I think OPEC's not next week, it's the week after, but commodities have come off the boil as well, really quite significant. In the metal space, copper has come down really quite sharply, and maybe a sort of closing of that gap between the physical market and what's happening with the financial trade, and how those two maybe kind of resolve themselves will be really interesting.
And we'll talk a bit more about commodities later in the programme, where we will be going to be joined by Max Layton, Citigroup Global Head of Commodities Research. So we'll get into that conversation around copper, around energy. I'm also looking at technology stocks a little weaker today, and I've got Mark's thoughts in mind earlier about, when rates rise, they rise for a number of reasons, and if they're rising for good reason, because growth is better than expected, and we saw that from US data yesterday, then you wonder what that does to expectations around stocks, and in particular the technology sector in focus, because it is so rate sensitive.
And that was kind of the divergence of 2023 versus 2024 in terms of the narrative, right? The 2023 is a very concentrated, tech-driven market. 2024 might be marking that change, and that it's far more of a broader rally, and that's a theme that we've heard from Beata Manthe over at Citigroup. It's something heard from Sharon Bell over at Goldman. We also heard it yesterday from John Bell over at Newton Investment. He joined the program. Take a listen to what he had to say.
Breadth is key. So we run an income portfolio, not necessarily focused on small and mid caps, but we are interested in breadth because the market has been so concentrated, so driven by large cap stocks, particularly in the US, and very much with an emphasis on growth, We run an income fund, so it's almost a quality value type of portfolio, so nothing to do with what's been driving markets. And that breadth that is starting to come into markets is therefore very interesting to us.
Let's get another perspective here. Alex Stanish, head of global equities over at Artemis Investment Management, joins us this morning on the show. Thank you for coming in on a Friday morning, by the way.
Morning.
Braving the weather. Let's build on the breadth story here. It's been such a pillar of the growth you've seen in 2024. Does it stick around for the back half of the year?
Well, there are a lot of moving parts to that question. Obviously, you're seeing quite a distinction today. Just looking at the US market last night, you saw Nvidia was up pretty strongly in the back of its results. So actually, quite a lot of the rest of the market was selling off, especially in semiconductors. So you have quite a divergence happening between some of the winners and some of the losers. It would be very reasonable to expect more divergence to continue through the year.
One of the kind of pinpoints of NVIDIA from a micro basis, and I'll macro this out in just a moment, is that as a company, they're struggling to diversify, where almost half of their sales numbers are coming from your 5 biggest tech companies. So to me, at least on the surface, it feels like a very easy liquidity transfer, even that they're sitting on so much cash, your Amazons, your Microsofts, et cetera. When we talk about the diversification, is that the leading indicator then? When NVIDIA diversifies, then the rest of the market will. Is there that connection to be made?
It could be. I think one of the things you have to watch is if you look where the demand trends are happening. So clearly the hyperscalers have been spending very large sums of money on NVIDIA's equipment as they've scaled up not only data centers, but AI versions of data centers. If you look more broadly in some of the commentary from the CEO, they're talking about a broadening in demand, actually, from sovereigns, so governments building AI-powered data centers to some enterprises moving in here. So you're seeing a diversification of that spend from that incredible concentration and incredible amounts of money coming from the big hyperscalers. And that will continue to go up by all expectations, but that broadening out to other parts of industry is quite interesting.
So that's one big trend we watch, is that push into AI, and we've covered it a lot with NVIDIA and the like this week. We've also talked a lot about this National Grid story, where they are seeking to raise £6.8 billion in capital. We got the news yesterday, dropped the stock yesterday. It's dropping the stock again today. Away from the specifics of that business, though, this plays through another trend, which is all about electrification. Alex, at Artemis, is that something you're following and investing around? And if so, where do you think the profits sit within that process?
It's a great question. So the way we think about the AI trend at Artemis is there are effectively 2 waves of this. There's the first wave, which is the enablers. You're seeing that come through in the semiconductor companies like NVIDIA. There's a lot of spend going into those specific areas. But as that sort of, and again, getting even the copper wires. You were talking about commodities earlier on. You've seen the copper price has come back short term, but it's up very strongly on a slightly longer term perspective. So that's the sort of bow wave of the first wave of investments. But as you siphon through over multiple years, you'll see the adopters, companies taking advantage of some of these technological improvements to create better outcomes. Very, very diversified set of companies are taking advantage of some of the technology here. So it's sort of in 2 waves. First wave, get the stuff built, run the software, get the program, see what we can do. Second wave, how can we use this for our company, our business, to make things more efficient, more accurate as well?
And as you mentioned, so the first wave is semiconductors, and that takes us to commodities, and you mentioned copper. So where do you sit on commodities at this point then, given those transition metals have had such a strong run, coming down again now, but a strong run?
Yeah, I think, again, it's horses for courses. So you have to look at the specific demand-supply trends for each of the commodities. I think the one that's has been called out would be copper. Long-term, the demand profile is pretty high, driven by utility spend, transmission spend. And that's not just from AI, remember. This is as you build a wind farm, an offshore wind farm, you need to plug that into the grid. There's a huge pent-up demand from that whole space on top of the AI trends. If you look at, I think the IEA was forecasting US power consumption to go up, by 1.5% a year for the next many years, having been pretty flat since the GFC. So these things are changing. You're seeing changes in trends. We like the dynamic for copper in terms of the supply-demand balance. You can see the demand for that coming through the corporate side as well, with BHP trying to get hold of Anglos. There's a lot going on in this space. So we think copper looks pretty well set.
The tension in the market at the moment is between that AI trade and all the derivatives of it, we've just discussed many of them, and what is happening at the macro level, particularly with the Federal Reserve and the pricing out of rate cuts that we're seeing so far this year. Bostic was talking about this yesterday. He's talking about the idea that he's the Fed is struggling to why we're not seeing policy having a bigger impact on the economy. And one of the factors behind that could be the financial conditions are very loose. The financial conditions was referenced in the minutes that we got earlier on this week. The Fed talks about the fact that a number of members noted the financial conditions were too easy. Financial conditions, when I hear financial conditions, I hear stock markets. So stock markets, financial conditions are too high. Stock markets, therefore, by extension, probably are too high. Is there a danger that we get into a position where we start seeing central bankers talking about this, particularly in the States, that the stock market is too optimistic at the moment, that the AI trade is driving these stocks to highs that are unjustified, maybe given the macro backdrop, and they need to slow this wealth effect down? How big a danger do you think that's going to be? And do you think that's something that investors should be becoming increasingly attuned to?
That's a complex question. I think how the wealth effect from the market affects different parts of society and different strata in society is very different, obviously.
Yep.
So if you think about that situation specifically in the US, where typically the wealthier portions of society benefit more from the market going up as opposed to the majority, that would counteract that argument slightly. But also, I think it's worth considering if you look at what's happening on the other side of the world. So you look at China; they're struggling to fight a deflation effect with the property market hitting some doldrums. So you've got an incredible spread of a difference in the economic conditions and inflation conditions. Right away from China on one end, you've got, and then the US on the other, with a very resilient market. Yep. So you've got that spread, which does create some relief to the overall.
Can I come at it from a different angle? I know you're an equities guy, not a credit guy. There is a huge amount of dry powder sitting on the sidelines at the moment. There's too much sort of dry powder in the credit space, chasing too few assets in the credit space. So credit spreads are getting tighter and tighter. Financing conditions are getting easier and easier. Another factor that the Fed may be considering when it thinks about financial conditions. All of these speak to the idea, though, that the Fed is looking at this going, we've got to slow this train down. How do we slow this train down? And is that something, again, that asset markets more broadly need to be thinking about?
Again, it's a good question. So if you look at I think two things. One, you think a little bit back, longer term, about the incredible distortions we've had from through pre-pandemic into the pandemic, post-pandemic. The economic data we've seen from this period is highly unusual. It's very, very difficult to usually sort of say the traditional rule book and go, this is what we do. This is the lag effect from interest rate policy on the economy. We're seeing quite a few distortions with that. So it's maybe not clocking in a traditional cyclical way. It's a more extended cycle, and so the time for this to have an effect has stretched, especially in the US. You're seeing that resilience come through from PMIs, from employment data, and that creates a challenge for the Fed in terms of if they want to drop rates. But if you think where we've come from more short term, just before Christmas, we went from having a very low expectation of any rate cuts at all to suddenly pricing 6 in the market, which is an incredible overreaction. Clearly, the benefit of hindsight, but even at the time, that's a big move. As we've gone through the year, that economic data and financial conditions has remained very robust. And so that's just pushed this timeline out. So it's extended the fade. Yep. The direction of travel still seems to be broadly the correct way, but the pace is obviously much slower than some would anticipate, leading to that sort of frustration you saw in the UK market just earlier this week when CPI data was a little higher, the FTSE came off. The opposite effect for bonds. So you have this just slow effect, which we still think direction of travel is working, but it's much slower than some commentators expected. That still seems to be tracking. Obviously, we're reviewing it constantly to see if there's any change there to that gradient.
Alex, very quickly, for a brand new buyer in this market right now, is this the entry point? Are valuations relevant at the moment?
Valuations are always relevant. So if you look at the spectrum of global equities, there's again a huge spread between what's working, what's highly valued on a high multiple, and what's not. So I think there's a wealth of opportunity out there, but you have to dig a little deeper than just maybe some of the more exciting stocks that people know well. We see some tremendous valuations of equities. Just interestingly, just on a compete, and a sort of an adject to this, if you look at the height that Nvidia's garnering at the moment, and quite rightly, the results have been staggering. There are other businesses benefiting from this quite well. So Synopsys, which is one of the electronic design automation stocks, the software which actually makes the semiconductors, helps you design them. So critically for pushing power efficiency up. Less power, you get more kind of output for your piece of silicon. Those things are working well in the background. They don't really get the same headlines, but those are sort of strong businesses working in the background, doing well. So if you find some opportunities off, or maybe a little bit off-piste, you can find some very interesting stocks.
Those derivatives trades are really interesting. Alex, nice to see you. Thanks for stopping by to see us. Alex Stanich, Head of Global Equities at Artemis Investment Management, joining us here on set. Quick look at the core six around Europe, just get an idea of what is happening with the bigger picture stocks that we watch every day to get a kind of sense of how the market is faring. And as you can see, plenty of red on the screen. This is we priced in the picture out of the States yesterday into the narrative here in Europe. Novo Nordisk, you could argue our version of NVIDIA, maybe over here in Europe, maybe clocking a little bit higher this morning, up by just a tiny amount, but still with some green on the screen. Joe Easton's got you some utilities. Let's talk about what's happening there. Joe, over to you.
So we are going to start with utilities because we've actually got a bit of a profit warning out of Spain. Now, this is coming from Acciona Energías, and the stock is down 5%, and they are weighing on a bunch of peers today, including Nordex over in Germany. Now, analysts at Citi describing this warning as perplexing because they don't actually say how much the earnings are going to decline. It's a very vague statement, but it is weighing on the sector this morning. We're seeing those coming down. In terms of your UK renewables, we did get news of a reduction in the energy price cap in the UK here, heading into this general election. How will that have an effect on that? We're actually seeing Centrica, the owner of British Gas, and also SSE, which had earnings this week. Both of those are coming down this morning. Then in terms of healthcare, we mentioned GSK getting that favourable court ruling on Zantac, but that potentially priced in. We're not seeing too much of movement there. But one stock that is dropping is Philips. Now, this is on a recall. I've printed out the FDA comment on this. It's on their Omnilab ventilator. The FDA warning in a serious category that this may experience an interruption or loss of therapy and cause hypocarbia and potentially even death, the FDA is warning. So it's a very negative thing. They say it's the most dangerous of their warnings, and that is weighing on Philips. It has been an issue for that stock for a number of times, some of these recalls on that space. Then in terms of deals, there's lots going on. John Wood Group rebuffing another takeover. The UK engineering company is the focus of a foreign takeover. That one is rebuffed once again. Flutter coming down. There is an issue around some shareholders of FanDuel warning that they do want more cash from that former merger. Andy Bell of AJ Bell selling shares in his company, and they're down 4%. It's weighing on that. And Sacyr in Spain, I was debating how to pronounce that, but a shareholder is selling a lot of stock in that, and we're down 6% on that one there. In terms of your cloud stocks, Workday in the US, a profit warning from them. The stock was down double digits, and we're seeing it weighing on SAP over in Germany this morning, taking the edge of that. Of course, the broader market is declining, as you mentioned. In terms of Maersk, Guy mentioned earlier, that is one of the best performers. I think this is related to Morgan Stanley upgrading their price target today. They say they're $7 billion above consensus on EBITDA because of the rising rates. Rates are up again. There's a story in the terminal about that in terms of the shipping rates. Finally, Ryanair going the other way. This one is downgraded over at Deutsche Bank. Now, Deutsche Bank warning that customers are starting to push back on higher prices when they travel. They say that this is something they expected to see, and we're all pushing back. We're not going to put up with it anymore. We're not going to take these higher prices, according to Deutsche Bank. Ryanair comes down 1.5%. They cut it to hold from buy, and it's declining over in Dublin.
Thanks very much, Joe. Joe Easton from our equities team with a full briefing on things on the move today. Coming up on the programme, it's a change at the top for Aberdeen. We have spoken about this one. Joe's been talking about this story as well. We'll discuss why the CEO, Stephen Bird, is stepping down and the outlook for this business. This is Bloomberg.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. South Africa's most important election since the end of apartheid focuses on infrastructure challenges, economic growth, and political fragmentation. Bloomberg's Jennifer Zabasaja reports live from key battlegrounds in Johannesburg, Cape Town, and Durban.
We think that South Africa is an exciting part of the world.
South Africa is a thriving and vibrant democracy.
There's a lot of expectation for the election.
Coverage begins May 27th on Bloomberg Television. Context changes everything.
The CAAC has asked for additional validation on a lithium battery in that recorder. And because of that, we have not been delivering airplanes to China recently.
Brian West, the CFO over at Boeing, speaking at the Wolf Conference yesterday, talking about this idea that actually you're not going to see a step up in deliveries, particularly to China, because the Chinese authorities have signaled that they probably would like those deliveries to halt as a result of concerns. It basically is around the battery that we use in the cockpit voice recorder. And the Chinese have some questions around that. What that is going to mean is that you are going to see this continuing strong cash burn coming out of Boeing as they can't basically monetize the aircraft they've already built by delivering them to China. That's when they get paid. And this stock got absolutely smashed yesterday. One of the big moves to the downside in terms of the US market was already under pressure, but Boeing was hit really hard on the back of this. There's been some semblance of signs maybe that actually we are going to see some delivery options increasing, but that's not going to happen in the next quarter.
Weighed on the Dow yesterday, I read, Guy, which I'm sure
we should ignore the Dow, but anyway.
We were having
ignore the Dow.
We were having this conversation while you were in
Pretty
Spain,
wants another
Chrissy.
hat.
Anyway.
Yeah, I do. I want the Dow 40,000 hat, and I can't seem to source one at the moment.
Well, maybe just give it time. Maybe there'll be another number, big
Dow 50,000, 100,000.
That feels better. 50,000. Wow, that would be.
Then you'll care about the Dow.
Yeah.
No,
not even then.
Let's not go that far.
Not even then.
Oh, my goodness.
Talking of things shooting higher.
Yes, of things that are flying high. There's a lovely story on the Bloomberg terminal about SpaceX and how you can potentially maybe get a share of the action here. And this is coming from a liquidity round. And I think around all of the excitement around SpaceX, you can't actually access it. This is not a publicly listed company. This is one of Elon Musk's many projects, of course. Value to get this $200 billion. It's the valuation here that's catching a lot of attention because they do these tender offers where basically employees of SpaceX can throw out their stock if they need to, the access that they have. They usually offer at about $108 to $110 a piece for this round of tender offer. It happens every about 6 months or so to kind of keep it going. $108 to $110, very accessible, much more accessible for the average retail investor than, say, a $1,000 NVIDIA share, for example. But the valuation is interesting. $200 billion, when 6 months ago, it was just $180.
So I instantly asked our colleague Daniel Curtis, where would that put it? If it were listed, what would be its comparably sized businesses?
We love a little size and scope at Bloomberg.
Exactly. So it would be like Disney, McDonald's, T-Mobile. These businesses are similarly valued to that $200 billion. In fact, they are a little smaller than what would be a listed SpaceX if it were to be listed. It would be the 41st largest US domiciled company.
And we think about the fact that NVIDIA is now bigger than the German stock market. It's an entirety. These are big numbers, and in size and scope, huge in comparison with some of the European stocks.
Yes, this is the size and scope that I'm sure our viewers tune in for. Let's hope so. Let's move on to other matters financial. Stephen Bird, the chief executive of troubled asset manager Aberdeen, has stepped down. The CFO, Jason Windsor, will become the interim CEO, and the firm will start a formal search process that will also consider external candidates. We're joined by Bloomberg's Tom Metcalf, who's been poring over the detail of this story. And Tom, so I said they're troubled asset manager, did I? I mean, take us back a little. What's the backstory here?
Yeah, I mean, look, he inherited a tough hand, right? Asset managers, particularly mid-sized ones like Aberdeen, they really are sort of in the middle of nowhere right now. So there's that move to passive investment. And of course, then, you need to scale in this business. So it's been a tough ride for him. And I think, I can understand why they probably made this decision. They're maybe looking for a fresh injection after 3.5 years. And interesting that, this CFO, James Windsor, it looks like he's going to probably take over if he's being made interim CEO. But yeah, it's one of those ones where it's hard to see, how much difference could he have made against, this huge backdrop of sort of industry-wide difficulties. And for me, I think the big message here is just what a tough spot asset managers like Aberdeen
It confirms that tough spot. Is this also, I was saying consolidation in this sector more broadly. Is this another indication that maybe this is a company which was created in so many ways out of M&A anyway, that we now need to see another deal being done? Is that what the new, be it Windsor or be it somebody else, ultimately is being brought in to do?
Yeah, I think that's ultimately probably the most obvious sort of exit out of their predicament, I would say. But the difficulty is they've had about 6 years of outflows. It's not like people are lining up to pick this one up because precisely for those reasons, it's not that much as attractive a business as it once was.
So the business itself is tough, but Stephen Bird as well wasn't necessarily popular right off the bat internally. I think one of his first moves was to get rid of bonuses for a lot of his folks.
Yeah, no, exactly. He had to take a lot of tough decisions, and I think, we did a piece a year or two ago kind of looking at just sort of the atmosphere in the company, and it has never felt like that company is a happy place necessarily in recent years. And then, of course, it was that famous rebrand where they knocked all the vowels out of the name.
I was just going to say, is that going to be the answer, Tom? I mean, do they just need to bring back the vowels?
Bring back the vowels. I mean, as an editor, I certainly like the vowels back because it still trips me up. But I mean, it's funny to say, but I do think that's one of the things that people remember of this time. It's
one of the first things that went through my head when I saw the headline this morning. So I apologise for that. Tom, thank you very much. Thanks for joining us. Bloomberg's Tom Metcalf with the latest on the financial services sector more broadly and what we're seeing specifically at Aberdeen. Coming up, we will talk commodities. We've been mentioning this throughout the programme. Copper is headed for its biggest weekly loss in more than 3 months. The backstory, though, has been very elevated copper prices. So we'll get to both of those themes. Where do we head next on the copper price? We'll talk about other commodities as well. We're going to be joined by, for a really good conversation around the copper market and the broader commodity space. Max Layton, Citigroup Global Head of Commodities Research, will be with us shortly. This is Bloomberg.
names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Was going to keep bringing the World Cup. This is a three.
As the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
This is March Today. We're about 30 minutes into the European trading day. Sentiment is pretty low when you look at the equity markets. Your stock's 50 down about 0.7%, similar margin for the FTSE 100. It's also sentiment that I would argue is bleeding into the commodity space as well. Copper, for example, on the back foot, down about 0.2%. Oil as well. Gold outperforming, but it is the only metal green on the screen right now. But let's zoom into that metal story, because copper, even though perhaps down only a little bit this morning, it is headed for its biggest weekly loss in more than 3 months. This, of course, coming as a strong dollar, the weak demand in China, all taking its toll. It also comes if you saw a big bump in the prices. Let's get a little bit more context here. Max Layton, Global Head of Commodities Research over at Citigroup, joins us this morning. We were just talking about a short squeeze in copper, and now we're seeing this kind of correction, mini correction almost. Walk us through the copper story, your initial views on where copper's going next.
Sure, yeah. Pleasure to be here. Thanks for having me. Look, on the copper side, it's been a fantastic run. It's had a fantastic run, and now I think all we're doing is we're kind of consolidating up here at levels which, frankly, according to my equity colleagues, equity markets were already pricing in these kinds of prices 3, 4, 5 months ago before the commodity rally. So I guess all you could say, all that's really happened is the commodity is caught up with the long-term bull story.
Is the commodity story, copper specifically, I'm really macroing this out. Guy and Anna can nerd out about the inner workings of the metal space. Is copper and its commodities, is it still a risk gauge when in terms of global growth, et cetera, or is this still a question of physical shortages, contracts that are splitting between London and Shanghai? How are you thinking about it?
Sure, yeah. I mean, I think 20 years ago, copper was trading its end-use markets. It was much more physical commodity. Nowadays, it can trade whatever investors think it's worth. It's very inelastic on the demand and supply side to price, and so it has these kind of quasi-equity-like characteristics now that you just don't see in oil. It's a 10 to 15 times smaller commodity market where we've seen $40 billion of long positioning come in, equal to 10 to 15% of annual consumption, and this is what drives price in the short run.
Can I turn to what's happening with the energy markets?
Of course, yeah.
Oil's down pretty sharply this week. They've got a OPEC meeting, not next week, the week after. Is that the next big event? Will that OPEC meeting stabilize prices? We're going into the driving season as well. I would have normally thought that the driving season in the States start on Memorial Day would be something that would be positive for prices too.
Sure, yeah. Look, short run, we're broadly neutral. We think OPEC Plus rolls forward the cuts. But, you know, I can see almost like an inverse copper trade over the next 6 to 18 months, you know, to the downside on oil. We're very similar, but, you know, the inverse sign. So oil has a lot of spare capacity. Copper has no spare capacity. Oil has a lot of broad-based supply growth, low-cost supply growth. Copper has practically none over the next couple of years. And, you know, they're both have very different exposures to the energy transition, you know, particularly China's aggressive push on the energy transition. It's bearish for oil at the margin. It means oil's beta to cyclical growth is lower and copper is higher. So I think, you know, 6 to 9 months ago, it was very difficult for people to put on the copper bull trade because they were worried about some downside risks in the short run. And it's the same thing the other way around in oil. You know, people are worried about driving season in terms of being bearish on a 6, 12, 18-month view on the structural dynamics in oil. They're worried about driving season, short run, hurricane season. You've got, obviously, Middle East conflict, Russia, Ukraine conflict. But ultimately, you know, we're seeing prices averaging $60 next year. So it's...
Wow, okay.
You know, it's...
Does that mean that the gas price, which I've seen ticking up recently, starts to reverse as well? Like there's a sort of strong degree of correlation there, because at the moment what I'm seeing is gas prices going higher, certainly here in Europe, and that's been a story over the last few weeks. It comes also on a day when we've seen energy prices here in the UK being marked lower by Ofgem, and I'm wondering whether that trend is going to be petering out. If you think the oil price is rolling over, does the gas price roll over with it?
Sure. I mean, there's certainly potential over the next 12 to 24 months for like a broader BTU surplus. And, you know, we're investigating that at the moment. I mean, short-run gas, there was some major production cuts in the US, and they're really tightening up the balances. Henry Hub up 50%. In terms of outlook, broadly neutral on gas from here. We think this is going to encourage, you know, these higher prices that we have now are going to encourage some restarts in the US. I think, you know, a lot of clients are interested in the risks around the pipeline gas through the Ukraine over the next couple of months with the contract expiry, and that's, you know, that's going to support prices up at these levels, but maybe not enough to, you know, really absorb all the extra supply we're probably going to see from the US.
Can I ask you, Max, about FX markets and the dollar and the role of the dollar here? I was reading some research by Bloomberg Intelligence saying that platinum, copper, silver, these are the metals that have the strongest negative correlation in their view, or by, you know, thanks to their analysis, to the dollar. What is your expectation there? Because that takes us into, you know, FOMC, Fed expectations, what the dollar does. How much are you thinking about that?
Yeah, we certainly think about that. The house view is quite out of consensus in terms of Citi Research's house view. We've got 5 Fed cuts this year, lower real rates into the end of the year, early next year. And that's certainly going to be, we think, the backbone of the next move higher in gold, right? So gold's probably the one that we think is most leveraged to that out of consensus view. We've got it going to $3,000 over the next 12 months. So oil lower, gold higher. 5 cuts and
the market is only pricing in 1 right now. Where does that leave gold? And I was going to come on to talk to you about gold prices.
Yeah, I mean, it certainly would make us less bullish, but I mean, the underlying drivers of gold are very physical at the moment, so we feel like the support for these gold prices, obviously gold's broken the relationship with real rates of late, and that's been all about colossal Chinese retail demand. I mean, off the charts. And China's, like, in my career, I've never seen China on the bid at the highs, and the dollar notional that they're putting into gold is, you know, we ballparked it, it's roughly 40 to 50% of what would have otherwise gone into property. It's a big shift from property spending into gold in retail in China. It mopped up about 2/3 of ex-China mine supply in the last 3-4 months. So, you know, really absorbing all the mine supply, that plus the central bank demand, and there's nothing left for the jewelry market.
And just I know Kriti's coming in, but does that change, that dynamic in China around gold? Does that change? Do you see anything that changes that?
Yeah, I mean, that is the biggest downside risk to gold for us, is that ultimately the government controls the quotas on the imports, and I mean, the imports aren't necessarily, their quotas aren't published, and they could dry up if the government becomes unhappy with the transfer of wealth from perhaps consumption and retail into physical gold.
So what's the way to invest in gold then right now? If I'm an investor looking at gold as potentially that central bank hedge or whatever your bull case might be, do you do it with the physical demand? Do you call your folks in Asia and say, let's stock up, or do you do it via the liquid ETF markets of the States? How do you access it? How do you get to it?
Sure. I mean, there's equities, ETF, the commodity.
Sure, but what's the most like lucrative like?
Yeah, I mean, CFTC. I always worry about getting these questions because I can only answer on the commodity side. I'm not allowed to give a call on equities. Certainly not allowed to talk about ETFs. But look, on the commodity side, we've got. I mean, I would say overall the action in commodities has been almost 95 to 99% copper from a client activity perspective, from what I hear about and I see. It's not so much been in gold. I think there's a lot of room for gold. I mean, frankly, many people, including ourselves, were scratching our heads as to what the new drivers were, and now they've become clear that it's China. I think we're going to get a lot more interest in gold because people can kind of get their heads around it.
Can I just come back to the China story and the housing story? Every time I see a headline, therefore, that the Chinese government is trying to resuscitate the housing market by delivering significant stimulus into that space, should I assume that I'm selling gold? If the housing market recovers in China, is that a negative for the gold price?
Sure. Yeah, so we've done a lot of thinking about that. I mean, it's coming off a low level. So, I mean, essentially there's excess savings in the country. And property sales are off between 20 and 30%, depending on the measures you look at in the primary market. I would say the recovery in housing would not take the heat out of the gold physical. And the reason is because it's not just about the property weakness. That's a reallocate, part of where the capital's kind of come from or been released from. But it's really about extremely poor sentiment from households and from the private sector generally about the economic outlook in China. So that's probably not changing. That's been something that we've been talking about for a couple of years now.
You mentioned that most of the conversation with clients is around copper, or you had some lines around that, Max. Does that mean that other metals that are transition metals also are being overlooked at this point? Are there opportunities in others?
Sure. Perhaps not overlooked, but I mean, the rest of the metal space has had a kind of a machine-computer CTA correlation and rally with the copper rally. I just don't think humans have really participated or got involved in that. I mean, there's other opportunities which have certainly got our clients really excited. Like, for example, lithium has a super outsized contango in its hydroxide market that we put out a couple.
Now you're talking.
I was about to say, let's get into the nerdy.
Super outside contango.
Yeah, I mean, 30 to 50% upside in trade recommendations we're putting out the last few months, and they're up 10% so far, 3 or 4 weeks. So it's
okay. One final quick question for me. These guys are going to get. Oh, the producer will probably get across me. Does volatility in commodities continue? Because the trading houses are making bucket loads right now, and just in terms of the volatility.
Sure. Jan, Feb, there was no vol. All of a sudden, March, April, huge vol in copper.
Yeah.
Vol in oil is at 10-year lows, around 10-year lows. So copper vol will come off and vol will settle down a bit.
Okay, Max, nice to see you.
Thanks.
Great to see you on a Friday. Max Layton, Global Head of Commodities, joining us from Citigroup. Really interesting to see what the trades are going to be around all of this. Kind of, if the copper story rolls off, do I read that as a macro story? I think the housing connection with China, China's just dominated that gold story.
We're getting some data out of China next week, so that'll be something certainly to watch. The fate of the Chinese economy, it gets everywhere. We'll be talking about it for European corporates. We can also talk about it for commodities, though, and gold.
Can I make a really nerdy connection here? We're talking about China. The copper, even the lithium story, that's also a Chilean story as well. There is a EM, South American trade built into that as well. I don't even have time to go into my favorite kind of commodities chart, which is Tesla and cobalt pricing, but for another day.
We'll save that for another day.
Yeah.
That sounds exciting.
We can do it next week.
We'll park that one.
Yes, when you guys aren't here and I have all the time to talk about it.
Right. The SEC has paved the way for the launch of the first US exchange-traded fund investing directly in Ether, the second biggest crypto asset. Let's get to the details. Bloomberg Daybreak Europe anchor Tom McKenzie has been delving into the details of this story and joins us now. Tom, how significant is this then? What do we need to know here?
It's a really big deal in the crypto markets. There's a lot of excitement about this. You'll remember, of course, when the spot Bitcoin ETFs were approved after a lot of pressure on the SEC, legal pressure. They finally, reluctantly, through gritted teeth, approved those exchange-traded products, spot Bitcoin. And of course, you saw these massive flows into some of these products held and created by the likes of Fidelity, BlackRock, and a number of others. So what they're hoping within the crypto space is that you'll see a similar kind of flow into ETFs backed by spot ether. We're not there yet. We don't have a time frame exactly as to when this could get to a final approval, but clearly it's a significant step. They've taken one step, the SEC, an important step in terms of getting to the point where they could be finally approved. Part of the debate now is whether or not they land on this is a security or this is a commodity. And of course, those within the crypto space want this to be labeled a commodity, something you invest in, rather than a security. There's all sorts of other legal implications if they come down on the security decision. But so far, it's a major step forward for those in the crypto space.
So commodity ETFs are famously very hit or miss. GLD works very well. Diamond ETFs, for example, famously do not. When it comes to the volatility story, could this, as a passive investment vehicle, then calm down the crazy volatility, the crazy swings you see in Ether?
Well, when you look at Bitcoin, it's been relatively stable. It broke above that 70,000 record level. There's some pressure coming through in terms of the Fed cut narrative on that. So I think that probably the jury is still out. Certainly those within the space would make the point, and they would argue that you would reduce volatility, that you have institutional players putting together these products. The concern clearly for the SEC all this time has been that you are exposing an ever larger slice of the retail and institutional investor base in the US to a product that isn't inherently risky, that's all that legacy about you being used for money laundering and cybercrime and all that kind of thing. That's been a question mark still for the SEC, and they lost these court cases and were compelled to offer these products.
Institutional investors, let's assume they've assigned all they're going to assign to crypto as a result of the Bitcoin move that we've already seen. Is this a zero-sum game, i.e., if Ether comes in, does Bitcoin lose out because just the totality of the number doesn't increase?
Yeah, that's a really valid question, isn't it? To what extent does Ether offer you something different that Bitcoin doesn't? It's got the blockchain capabilities and underpinnings that are different to Bitcoin, and something that the proponents of Ether say makes it very distinct from Bitcoin. It's an architecture that can be more easily implemented for all sorts of different use cases. So if you're lifting the lid and getting all granular, then that's maybe where you make the distinction. But to your point, if you're a regular retail investor or an institutional investor, you just want 5% or 2% exposed to crypto. Does it really make a difference? Does that really start to play out? I think that's a really valid point, and we should start to watch that once, and if, of course, they get approved.
And if higher for longer is the narrative around broader markets, then what that does to crypto is also something we watch. Thanks very much, Tom. Thanks for joining us. Bloomberg Daybreak Euro banker Tom McKenzie breaking down the Ether story, the latest in the crypto narrative. Coming up on this programme then, a two-speed global economy is the elephant in the room, it seems, at the G7 finance ministers as they gather in Italy. We are live there next. This is Bloomberg.
Operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on
that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
This is Bloomberg.
This is NATO's eastern line of defense. Tensions are running high, and here in the Baltic states, the military alliance is building an advanced presence to counter one country.
Russia have the intention to trust NATO, and it's a question how much opportunities we will give them.
While troops on the ground are a big statement, there is a number behind the scenes that's far more significant.
2%. 2%. 2%. 2%.
That's the share of their economic output that NATO members committed to spend on defense. But for a while, countries didn't get anywhere near that number. And under multiple administrations, the U.S. hasn't been happy about it.
They said, well, if we don't pay, are you still going to protect us? I said, absolutely not.
The threat from Russia means that is starting to change.
We have no time. We have to be prepared as fast as possible.
Now, some are asking if 2% is even enough.
NATO spending a big theme right now, and Europe is playing catch up. How does it finance it? How does it deliver it? How does it make sure the industrial base is capable of providing the weapons that Europe now so desperately needs, it seems? And how at the same time do we continue to finance what is happening in Ukraine? That is a big subject, certainly for the G7 finance ministers. They are gathering in Italy today. Ollie Crook is monitoring events. Ollie, let's start off with this issue of how we continue to finance the Ukrainian conflict, how the West, how Europe provides funds for the Ukrainians. This is a big subject, and it does seem as if we're starting to coalesce around some clear ideas about particularly how we use Russian assets to be part of that puzzle. Talk us through the arguments and how it's developing.
Yeah, that's right, Guy. That really is kind of the main deliverable, I think, that the G7 finance ministers want to leave this meeting here in Stresa, Italy with, which is basically what is the architecture for monetizing these Russian assets in a way that is internationally compliant with law, but also hefty enough to make a difference and really get the financing for the Ukrainian war effort on sound footing, not just for this year, but for the years to come. And so the question initially was, shall we seize the underlying assets? That was the U.S.'s plan. The Europeans say, hey, that's a little bit too rich for us. But what we'd be open to, and this is the U.S. plan, is monetizing the future profits of those assets and maybe cutting a check in the next couple of months for about $50 billion. That's where the conversation has sort of coalesced. Where it's reaching some difficulties is who is going to sort of back those dollars and that money if, say, you have a peace treaty that is signed in 5 years and you've sort of you've promised the profits for the next 15 years, who's going to write that check? So these are a lot of the technical questions that are behind this. But for the G7, it's really important for them to come up with a decision here because, as Janet Yellen said yesterday, Putin is waging a war of attrition. And if the G7 can't get it together and really prove their commitment there, then Ukraine is going to be in big trouble.
Ollie, where does China stand in all of this?
So So what's interesting is Yellen made it very clear yesterday. She wants China and the trade practices to be a really sort of central role in the conversation here. And just a few minutes ago, we were just speaking with Bruno Le Maire, the French finance minister, who echoed some of the same sentiments. Have a listen to what he had to say.
We should definitely avoid any kind of trade war, because a trade war is neither in the interest of the US, nor China, nor Europe, nor any country in the world. But nevertheless, we have an issue with the unfair trade practices, with the high level of subsidies, and with the industrial overcapacities. I'm the Minister of Finance. I'm also the Minister in charge of economy. And I will spare no effort to defend our industrial interests.
So you had a little bit of hedged language there from the French finance minister, but the message is pretty clear and unified for the G7 that the Chinese unfair trade practices will not stand. But I asked him in that meeting, listen, the United States throws up these trade barriers, and they do it very fast. All of that overcapacity that they're trying to address then often shifts over to Europe. How do you address that? Do you need to come up with a G7 solution to that problem and be more unified? And one of the things that we got out of there that we need to chase a little bit more detail on is that they've apparently tasked the IMF with coming up with a report to look at how the Chinese trade practices are affecting the global economy. So that's something we're also going to be chasing while we're here.
Thanks so much, Ollie. Bloomberg's Oliver Crook with a briefing from that G7 event in Italy. Thank you very much for joining us. All of that working up towards the G7 leaders event, which comes in June. So this is the finance element. We will be there, of course, conducting interviews for you at this finance meeting of the G7, including with Paolo Gentiloni, the European Economy Commissioner, plus an exclusive conversation with Joachim Nagel, the Bundesbank President and ECB Governing Council member.
Of course, we're going to have full coverage there. Ollie really leading the charge there. So we're going to get those headlines throughout the rest of the day. But there's also some data that we want to keep an eye on as well. At about 1:30 p.m. UK time, we get that U.S. durable goods data. We're talking about factory orders, talking about manufacturing story in the States. This is going to be one more data point that we've got our eye on. We've also got AGMs as well when it comes to Total Energies, I'm going to say that right, Amundi, and a couple of others as well. So you want to keep an eye out on the stock-specific story as well. But central bank speakers are also going to really shape the narrative. The macro versus the micro seems to be a really interesting kind of tug of war here, as Anna was talking about earlier in the show. Schnabel, Jordan, Waller, we get lots of voices from around the world, plus, of course, those sovereign rating updates. Always fun for those folks staying up in the States on a Friday night.
Yeah, just a little bit of a last-minute kicker, maybe.
Yeah.
It very rarely produces a surprise. Very rarely, even if it does produce a surprise, produces a big market reaction. Next week is interesting. Next week is about PCE. Next week is about us back to this inflation narrative. And there's been certain elements of the data we've seen over the last few days that maybe point us to the fact that that number is going to be maybe problematic and is going to further confirm this idea that the Fed is stuck and is not going to be moving anytime soon.
Yeah.
And I wonder how much more pricing out of rate cuts we're going to see this year.
Yeah, and I wonder what role the PCE will play in this conversation, because I was looking at the estimates on the Bloomberg terminal, actually, and we're not expecting much of a move in PCE. No. It's sort of stuck at 2.7%. If you're looking at the PCE deflator, of course, year on year, the month-on-month number, expected to stay stuck at 0.3%. This bit of data, if things stay as they are now, this bit of data will drop into a market that's busy pricing out rate cuts from the Fed and unmoved inflation data. I wonder then how that lands.
Well, this bond market, in addition to the data, is very sanguine as well, because we don't really know what the narrative really is, because we start every Monday, it feels like for the last couple of weeks / months, saying, look at all this Fed speak we have, look at all this commentary, all this data. The markets move, and then we end on Friday exactly where, at the exact levels that we started the week off. You can see it today, for example, with the 10-year yield. How much different changes did we get from the FOMC minutes, from the bond story, even the read-through from NVIDIA into cross-asset, and yet, net, the 10-year yield still 446.
We should just do programs on Mondays and Fridays then, maybe.
I think so.
Yeah, that's
but Monday the Americans are closed. Yep. It is Memorial Day. We're closed here in the UK as well. We get the holiday that everybody else got in Europe last week. It's a big weekend of sport coming up as well. Just to
Are you just going to brag for the last 30 seconds of the show?
Exactly. Yeah, all of these things are happening. Manchester's basically coming to Liverpool this weekend. We've got some great tennis that's going to be on too. It's a long weekend coming up. Not for Critty, but for some of us.
I'm going to be working like a normal person.
We are very happy that you're able to do that. Critty will be back with you next week. That is it for Markets Today. The Pulse is up next. Markets are weaker. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. G7 finance ministers and central bank governors are on the Italian resort of Stresa for their annual meeting. The agenda includes support for Ukraine and how to use frozen Russian assets. Now, traders push back at U.S. rate cut expectations to later in the year after strong economic data. We discussed with the chief investment officer of UBS Wealth Management. Plus, Bloomberg understands that SpaceX is planning to sell shares that could value Elon Musk's company at roughly $200 billion. Now, also later in the show, our exclusive conversation with Timur Hayat, the chief operating officer of PGIM, which has more than $1 trillion in assets under management. So, U.S. PMI data for May in both services and manufacturing surprised to the upside. Now, the strong prints have spurred bets on the Fed holding gates until December. Well, I'm delighted to be joined by Mark Hayfley. He's Chief Investment Officer for Global Wealth Management at UBS. Mark, so good to speak to you. I mean, today's the day where G7 finance ministers meet in Stresa with a beautiful background to talk whether the strength of the U.S. economy can, continue. Is it durable and stable?
Yeah, and look, I think that we see a picture where there's a soft landing in the United States, but the important thing there is there's still a landing. We think that U.S. inflation is going to come down like we see it coming down in Europe, and that's a good backdrop for both stocks and bonds into the second half of the year.
So what does that mean, Mark, for, amongst the G7 countries, Eurozone and ECB is probably the first one to cut. We'll see if we have confirmation of that June 6th. But what does that mean for actually portfolio building?
Well, I think that, people are getting a little lost in some of the details about, the Fed minutes and longer-term questions that both the U.S. and Europe are facing about how changing demographics and a service economy might lead to, rates not going back to zero again, like they did before the pandemic. But in terms of portfolio construction, I think there's a couple things that people should think about here. First, with both stocks and bonds looking attractive, you want to get that asset allocation in play. I think second, if rates come down, a lot of our clients are holding a lot of cash, and so they need to think about getting out of some of that cash and into some of these allocations. And then there's also a question, we think that around the U.S. election and all the other things going on in the world, there's probably going to be some volatility. So are there ways you can use that volatility to use some structures or things? Volatility is very low now, to prepare yourself for potentially higher volatility in the back half of the year.
So is the AI growth still intact, Mark? I know, it's for me a little bit uneasy at times reading that actually it's NVIDIA that frankly moves like hundreds of trillions of dollars because it props up or it makes the whole market fall. But how do you feel about it?
Yeah, well, within the equity allocation, I think we're seeing some positive trends. We've been overweight AI. We think, we've been saying this is certainly a real trend. And we were heartened to see in the this earnings period just how much the CapEx exposure to AI has been increasing. And so we think that the trend can continue. I mean, the phenomenal revenue growth, something like 262% year over year for NVIDIA is astounding. But the trends there for AI and that bottleneck around chips seems like it's going to continue for some time. At the same time, it's good to note that the equity rally has broadened out, both away from tech, but also globally.
So where are you expecting the biggest gains to be from now until the end of the year? First of all, I mean, if equities are supported, again, is it across the world? Do you look at sectors or do you look at regions?
I think that it's a little bit thematic, the way that we're looking at it. So certainly tech is one area, but another area where we see gains is kind of the feeding the power and the infrastructure around this AI revolution, and that leads us to things like commodities, and so we actually are overweight in the UK, where valuations are attractive, the economy is improving, and you get some of this exposure to commodities and infrastructure that we like.
What's your take on elections, Mark? I know that there's many elections. I mean, the U.S. election will have implications for foreign policy, for allies, for regulation, for banks, for a little bit of everything. So, are the policies clear, or are we wait and see?
Yeah, I think that, for a lot of our clients, they need to take a little bit of a step back and realize that probably the most important thing is the composition of Congress in relation to the president, and that's not necessarily known yet. But broadly speaking, elections, while we follow them in the headlines, they don't necessarily have such an impact on the portfolios. All of that said, there would be a difference, we think, in terms of the sectors and some aspects of the trade policy, depending on how the president and the Congress shakes out. It's probably a little too early to tilt your portfolio on that, if it's ever a good idea to tilt your portfolio on that. But these kind of questions are one of the reasons we see that volatility picking up in the second half of the year.
I know you like actually U.S. small caps within your asset allocation. Again, does that change on who gets into the White House?
I don't think that changes right away based on who gets into the White House. The idea of small caps is, in our base case, rates are going to fall, and that will hopefully answer some of these questions that have been dogging the small caps around how are they going to refinance and other things. Now, certainly, there are questions around where the infrastructure spending that is going on in the United States goes to, which states, which industries. So all of that can impact small caps as well. But if the economic strength continues and the rates begin to fall, that is a very that's a very good backdrop for some of this disparity between the large and small caps to close.
Mark, talking of election, it was also a big week here in the UK with the Prime Minister calling for that election on July the 4th. I know you also see value in UK stocks. Again, do you make a difference between the big companies or the small caps?
Yeah, I think we're much more interested in the larger companies that have the more global exposure. I don't think that the election in the UK, I mean, certainly if we had a surprise, on July 4th, that might change things a little bit. But the desire to have an election, the date of that, I don't think that's going to change anything about our views on being overweight the UK right now.
What do you do? I know you like fixed income as one of your preferred asset classes, Mark. What do you do with currencies? Again, dollar strength for a while put a lot of pressure on a lot of emerging markets.
Yeah, I think that we expect if people start to price in the Fed lowering rates as we expect, that could take some of the edge off the dollar strength, especially before the election. How much dollar weakness we're going to see given the global turmoil, and right now betting markets and the polls are looking towards a Trump presidency, which often has a lot of headline-grabbing news that might be strong for the dollar again. So there's questions around that. But when we look at currencies right now, I think one of the things we're seeing is that the Swiss franc has really been a currency that people have funded out of, and we think that some of that is overdone, and so we're neutral now on the Swiss franc. And we still like the Aussie dollar. We think that's going to be one of the last central banks that will cut, and it's got that commodity exposure that we like.
Mark, thank you, as always, for joining us. That was Mark Hefele, the Chief Investment Officer for Global Wealth Management at UBS. So we were just talking about it. G7 finance ministers are gathering in Italy, where a two-speed global economy is overshadowing this week's meeting. Now, officials are confronting the prospect of less synchronized monetary policies amid a resilient U.S. economy, but also tepid growth in Europe, colored by nearby geopolitical tensions. Now, let's bring in our correspondent, Oliver Crook, who's in Italy, I would say, with a pretty ugly background. Ollie, so what's topping the agenda right now?
Yeah, Francine, as you say, the kind of mood music in the background is this sort of question about sort of the bifurcation in sort of the growth, but also within the global economy. But in terms of the deliverables of what the finance ministers of the G7 want to take away from this meeting in Stresa, Italy, it is really to find a plan for those Russian assets, how to get the financing for the war in Ukraine on stable footing, not just through this year, but through next year. And of course, the initial debate for the United States was to take the underlying assets. The Europeans said, that's a little bit too rich for us. We need to find another alternative. So they've suggested the windfall assets and really cutting a check today of a very large sum of up to $50 billion in order that are based on the sort of future earnings of those Russian assets. That is one way of doing it. There are some technical issues, and that is really what these guys are here to resolve now, so that they can be in front of the G7 leaders meeting in 3 weeks' time, that they can have a sign-off to really get that funding under sound footing. The other question and the other elephant in the room is China, the trade practices. And we've been hearing about it from Janet Yellen yesterday, and we just heard from Bruno Le Maire just a few minutes ago. Have a listen to what he had to say.
We should definitely avoid any kind of trade war, because a trade war is neither in the interest of the US, nor China, nor Europe, nor any country in the world. But nevertheless, we have an issue with the unfair trade practices, with the high level of subsidies, and with the industrial overcapacities. I'm the Minister of Finance. I'm also the Minister in charge of economy. And I will spare no effort to defend our industrial interests.
And so while China was not an explicit topic going into this meeting a few weeks ago, obviously it is also going to dominate the conversation. Can the G7 get a unified message, particularly vis-a-vis China and its trade practices?
Ollie, thanks so much. Oliver Crook there in Stresa, Italy, for the G7 finance ministers. Now, plenty more interviews from the G7 today, including Paolo Gentiloni, the European Economy Commissioner. Plus, we also have an exclusive conversation with Joachim Nagel, the Bundesbank president. Coming up, we're talking private markets with Mathieu Chabron, the founder of global alternative asset manager Tikehau Capital. That's next, and this is Bloomberg.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Private credit. Well, credit bulls say corporate bonds hold the biggest edge over stocks in years. According to data compiled by Bloomberg, credit is trading at the biggest value gap with U.S. equities in more than 20 years. Now, for Europe, the same measure actually goes back at least a decade. It's a trend that's breathing new life into the conviction of credit investors. Now, let's discuss all of this with Mathieu Chabron. He's co-founder of asset management and investment firm Tikehau Capital. Thank you, Mathieu, first of all, for being here, and welcome to London. You also celebrated 20 years of Tikehau, so congratulations on that. Every conversation I have, be it with Goldman, JP Morgan, and anyone in between, is credit, private credit. Is there a danger that this gets overheated?
No, I don't think so, Francine. I mean, first of all, thanks for having me. You know, credit is the driving force of any economy, right? And there's been having these past 10 years way too much liquidity that was probably mispriced. And so if today people are excited about credit, it's because you can at least, you know, now eventually get the proper risk premium, you know, for this type of investment. The compounding effect of credit, which is the basis of this strategy, is what investors are looking for, you know, globally. So I'm not surprised that bank, insurance companies, sovereign wealth funds look into that. I'm part of the skeptical about the bubble, you know, of saying, you know, either too much money chasing too few deals. So I still believe it's a great asset class to invest in.
Yeah, and there's a lot. I mean, I guess, you know, the pros is that it is a new asset class. There's still quite a lot of value to be made. Again, valuations, people have concerns about valuations. And again, as you mentioned, liquidity. Are there parts of private credit that you worry about in terms of valuations?
It's very interesting you bring up, you know, liquidity, because the public credit market have been extremely active, but with a huge dispersion. I mean, we are today in this situation of a K curve. You know, if you're, you know, even in the high yield space, I mean, you know, like a double B, you know, you're trading pretty tight. But if you're a triple C, you've never been that wide, actually wider than what it was, you know, during COVID. And for me, that is the illustration of the liquidity being constraints, obviously chasing certain assets, and that's where the opportunity is, right? Because not everything's going to go default, right? It's not going to go bankrupt everywhere. And so this dispersion is what is creating a great opportunity for private credit and, many people looking into it.
But Mathieu, I think if we probably take a breather, so there is, the inflation environment has changed significantly. It's gone really rapidly. I don't know whether we've seen the pitfalls from that, but also the cost of credit and the cost of money in general, almost for structural reason, has gone up.
Yeah, no, I mean, for good reasons, because, if we, 1 second, on the inflation, as far as we are concerned, at TKO, we believe that effectively this sticky inflation is here to last. And when people think that, short-term interest rates are too high, relative to the long-term, we would go the other way around. Maybe the long-term interest rates are still actually, too low. So once you factor that in, effectively, and back to your question, on the credit spread and the cost of money, it's absolutely fair that today you have these type, of spread and pricing. And effectively, if it costs now your LIBOR, SOFR, LIBOR plus 400, 500, 600 in certain instances, from an investor standpoint, that's one of the best, value proposal we can have.
So where do you see the best clients and the best deals? You're based in New York. Your co-founder is actually based in Paris. What we're being debated today also at the G7 is the fact that how much does growth, stay in the U.S. and for how long compared to a weaker Europe?
Well, there is first, a structural opportunity that goes beyond, the geographies, which is providing this liquidity. Once again, the liquidity has been drying up, the central banks have been, retrenching, and the remaining liquidity has been chasing the same assets, right? So those large cap, effectively some high-grade credit, and it leaves, some whole part of the market with a much thinner liquidity actually than pre-COVID, and that's where the opportunity is. And that's a global comment, and it's true in credit, obviously, in real estate, in secondary private credit, which is an asset class that's been developing, significantly in the private markets. Now, when it comes to Europe and the US, obviously the decorrelation, is increasing, living over there, and there were, some headlines, on your program earlier on today. I mean, effectively in the US, I don't see a cooling, in prices, in inflation. It's a fully levered economy, so it's functioning, rather differently than here. In Europe, you have to be local. You know that better than anyone else. Doing business in Milan is not the same thing as Frankfurt, Paris, or Madrid. And that's where the opportunity lies for people like TKO.
So what does it mean for TKO in terms of expansion? I know you had been working on your deals. Where do you see the biggest growth for the next? I'm not going to ask you 20 years because a lot can happen in 20 years, but maybe next 5 years.
Well, 20 years goes by, pretty quickly. I've just experienced that. But the first geographical expansion has been really east. So, we've been in Asia for some time. We made some big announcements earlier this year in private credit, as a matter of fact, in Southeast Asia. We also expanded into the Middle East operationally, in Israel, in Abu Dhabi more recently, some further plans, to expand into the kingdom, in Riyadh, because obviously the investors and the asset owner over there, that's what they're looking for, platforms to deploy in the credit space, in anything that is yieldy. So credit, real estate, infrastructure. So that's where we see, the extension short term.
I mean, real estate, again, we've been talking about a bubble bursting for the last 18 months. Is that working its way through? Is it a good opportunity to buy maybe some of, the lower valuations of real estate, or how do you see that developing? Absolutely.
We like this dislocation because this is when supply-demand is such an imbalance that it creates, the buying opportunity. And when you've got, the same people selling, and you saw some headlines, yesterday again, on some open-ended funds, most of the time, in my experience, and unfortunately now, it starts, getting richer, every year, you don't die because of your assets, you die because of your liabilities. And I think the mismatch that we've been seeing in some illiquid assets, and real estate being, probably the most illiquid of them all, no, you cannot have a daily liquidity on these type of assets. So once you've got this supply-demand imbalance, these flows, contrarian flows, that's where we step in and make, good investments.
So interesting. Mathieu, thank you so much for coming on.
Thank you, Francine.
Don't be a stranger. Come back very soon when you're in London. Mathieu Chabran there, TKO Capital's co-founder. Plenty more to come. This is Bloomberg.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg. South Africa's most important election since the end of apartheid focuses on infrastructure challenges, economic growth, and political fragmentation. Bloomberg's Jennifer Zabasaja reports live from key battlegrounds in Johannesburg, Cape Town, and Durban.
We think that South Africa is an exciting part of the world.
South Africa is a thriving and vibrant democracy.
There's a lot of expectation for the election.
Coverage begins May 27th on Bloomberg Television. Context changes everything.
If there's a rate cut, fine. If there's not, then it's the question of how companies then react to that. How do they then build their businesses to exist in a rate environment which is higher than it has been the last 15 years, but I would argue that the last 15 years have been an abnormal rate environment.
Well, that was HSBC US and America's Chief Executive Officer Michael Roberts with Bloomberg's Manners Cranny. Coming up, our exclusive conversation with Timur Hayat, the Chief Operating Officer of PGIM. We're talking bonds, energy, and much more. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday. Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry. And
crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
G7 finance ministers and central bank governors are in the Italian resort of Stresa for their annual meeting. Now, the agenda includes support for Ukraine and how to use frozen Russian assets. Traders push back U.S. rate cut expectations to later in the year after strong economic data. Plus, Bloomberg understands that SpaceX is planning to sell shares that could value Elon Musk's company at roughly $200 billion. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, stagnant living standards will likely impact Prime Minister Rishi Sunak's chances of re-election when the UK goes to the polls on July the 4th. Inflation, of course, a big part of the problem, but there's a deeper structural issue, and that is weak productivity. Now, we have a full analysis from, of course, our team on the ground here in London. So for more on all of this, we're joined by Bloomberg's Phil Aldrich. Phil, I've been dying to speak to you all week because it's been a big week in UK politics, but also a big week to try and understand whether the economy is in the Prime Minister's favor or not. Why do you think he called an election on July the 4th?
Yeah, that's the big question. A lot of people, nobody quite understands why. There's a theory, so you can think of it in two ways possibly. He wants to avoid negatives. So there are issues like potential MP exodus, so more defections, and he can be seen like he's clinging on to the post, and that he effectively gets forced into an election. It just looks very weak. So you get on the front foot, and then there are the possible positives, such as that he's obviously trying to get the Rwanda boat scheme to be a key thing in the election, and he. Reform, who are the right-wing party that is threatening to steal a lot of seats. He can marginalise them by going a bit early, and at the same time make the boats issue, this Rwanda policy, an issue which could bring the right wing that would vote for reform back onto his side. The economy is recovering, so as the sun comes out, there might be sort of better weather in the economy as well. He may have been hoping for rate cuts. It's now looking increasingly unlikely that those rate cuts would come as early as June, so August or maybe later. So the feeling, the feel-good factor that Hunt, the Chancellor, has been talking about, will be too late, really, for people to acknowledge. And things like tax cuts, that he's already done 20 billion of tax cuts, and they got no help in the polls. The polls did not bounce for them. So it's like, if they want to do another fiscal event, what's the point? Because it doesn't seem to be working. So, all those factors may have just coalesced into sort of convincing him that might as well just go now. But yeah, it's a bit of a surprise.
No, I guess there's the Tories are so far behind in the polls. I don't know whether it's more about understanding some of the Labour policies, and they don't have to do much. You were saying this to actually win this at this point, unless there's like a huge upset. And so it's not. It's an election to try and understand, what Labour policies mean for the economy more.
Yeah, well, we should be getting. Both manifestos should be out in the next couple of weeks, and we'll get a clearer idea. But the idea that Labour is going to come up with a radical set of policies that they haven't already prepared business and the markets for seems for the birds. Bizarrely, the positions of the parties are effectively reversed here, because the government would normally be going in on the front foot, but here the government is the underdog, and the Labour Party are the next government-elect, more or less. So they just need to be stable. They don't need to rock the boat. In a way, it's up to Rishi and his team to sort of come up with the radical vision and actually convince people that they're... And of course, that's not what they're doing. They're saying we need to be we're the stable ones, but Labour are also... their whole policy is effectively, in many ways, very similar to the Tory stability policy. And so I don't think they won't want to scare people into voting for the Tories instead of Labour.
So, Phil, this is really complicated for the Bank of England, or maybe more complicated for the traders, because they have this self-imposed purdah, essentially, right?
Yeah.
So we're not going to hear from BOE officials until the election. And I don't, what does that... If you're a trader and trying to understand when the cut is coming, this is not going to be great for them.
Yeah, there'll be less... Actually, some people might say it's better. There's less confusing signals. but fewer confusing signals. But we're not going to. The Bank of England it doesn't have to apply the PERDA rules that apply to other civil servants, but I mean it's very sensible and they do apply them. So they won't be making public statements, but there will be business as usual. So we will still get the MPC minutes. Yeah. So if there is changes in language on June 20th, we'll see that. And then the financial stability report will happen, but there won't be a press conference. So it's these kind of public appearances or public statements that are going to be missing. But I think
it'll be interesting for the markets to see.
Yes, I mean, do they prefer it when the bank policymakers are quiet or when they're actually talking a lot? We'll see.
Yeah, this is so Italian. Take a day off, take a month off, guys, because there's nothing to do if you're on a trading floor, on some of the FX trading floors. Phil, thank you so much. Phil Aldrich, they're a senior reporter on the UK economy, who also recently actually won an award. So congratulations to you and the team for that, Phil. Now, European NATO members are racing to bulk up their militaries in the face of Russian aggression and the possibility that Donald Trump, if elected in November, may try to reduce American involvement. Experts say NATO nations and their allies may need to at least double their defense spending to deter any potential Kremlin threat.
This is NATO's eastern line of defense. Tensions are running high, and here in the Baltic states, the military alliance is building an advanced presence to counter one country.
Russia have the intention to trust NATO, and it's a question how much opportunities we will give them.
While troops on the ground are a big statement, there is a number behind the scenes that's far more significant.
2%. 2%. 2%. 2%.
That's the share of their economic output that NATO members committed to spend on defense. But for a while, countries didn't get anywhere near that number. And under multiple administrations, the U.S. hasn't been happy about it.
They said, well, if we don't pay, are you still going to protect us? I said, absolutely not.
The threat from Russia means that is starting to change.
We have no time. We have to be prepared as fast as possible.
Now, some are asking if 2% is even enough.
A Bloomberg mini doc on the issues faced by NATO with the war in Ukraine and potential political change in the U.S. Coming up, we talk to the PGEM COO on investing in the green transition and why he's excited about avoiding the hype. This is Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Was going to keep Rain World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
the conversations that matter, the insights you need. This is A Pulse, and I'm Francine Lacqua here in London. Now, the energy transition has created an array of attractive investment opportunities. Now, our next guest is most excited about, quote, avoiding the hype, which is all the title about, well, on the research paper he's just co-authored. Well, Tamer Hayat is Chief Operating Officer at PGIM, which has more than $1 trillion in assets under management. Tamer, as always, thank you so much for joining us. I mean, this is a beautiful piece of research, and it's basically avoiding the hype on both sides, like not being in the portfolios or the companies where everyone wants to be in, but also not believing this hype of diversity and actually the energy transition is over. So what opportunities do you see in this space?
Yeah, it's, energy was always complicated, Francine, because you sort of have to balance affordability and reliability and clean energy. And that just has become much more complex for investors these days because you've got, all the post-COVID supply chain issues. You've got 2 wars, you've got inflation raging, and sort of energy sort of underpins all of that. And when we looked at that landscape, there are an array of attractive investment opportunities, and they're across both the green energy side, but also kind of the brown villains have probably been caricatured. I think in this transition world, there are opportunities on both sides. But what really struck me was just the number of ideas which are great for governments to invest in, great for researchers and academics to look at, but probably not yet ready for investors, and yet there's a lot of hype about them. And that includes things like hydrogen and carbon capture and nuclear fusion. I think for a variety of reasons, getting to an investable opportunity for private sector investors is either too distant, too uneconomic, or just politically ultimately will be unfeasible.
But are we underestimating actually the pace at which the transition is already happening? So a lot of, if you speak to a lot of the oil majors or the mining companies, they say, look, we're not ready for the transition because we haven't mined enough of the copper, of the things that we need for the transition. Again, is it delayed or is it still going ahead but just at a slower pace?
I think just the sort of unpleasant or inevitable arithmetic of global demand for energy, with 80% still being fossil fuel driven, means that for the next 3-4 decades, I'm afraid well beyond some of our net zero goals, we will have a reliance on fossil fuels. So again, this idea of kind of, green heroes, brown villains needs to be more nuanced by investors. And, there's still tons of opportunity on the green side because that transition is inevitable, has to happen and is happening and has been happening for 20 years. And I think we'd say there it's a little bit like the picks and shovels versus the gold. We see the opportunity in renewables a little bit more on the infrastructure side and the kind of underlying pieces that you need rather than in solar or wind itself, which I think is a little overpriced at the moment.
There's a market obsession with, of course, what the Fed does, and also this differentiation between, the ECB and the Fed, and the fact that the cuts are delayed there. What does this all mean for debt financing? Where do you see it more attractive for the green transition?
I think actually debt financing, particularly just given the level of competition in the renewables world, particularly in the EU and US, is the way to play many of this. Okay. Because you've got the Fed pressures, but you've also got banks receding from the middle market in both Europe and the US. So actually we found far more attractive opportunities in, say, copper miners or copper companies in solar and wind, and increasingly in hydrothermal in Latin America. And everybody forgets emerging markets. I mean, India is the 3rd largest renewable producer, but there's massive additional demand. So there are renewable opportunities there. Those are probably more in equity, but in many other places, the right way to play this is in debt with very solid cash flows, incumbent advantage, rather than the equity space, which I think has got crowded and spreads have compressed.
So when you look at solar and wind, mainly in Europe, some of the on the debt side, or also in the U.S.?
Solar and wind with, regulatory subsidies and competitive pressures, definitely not on the equity side, on the debt side. Hydrothermal in Latin America. And then things like wind turbines and, underpinning all this, whatever the source of electricity, whether it's nuclear, renewables, carbon, you've got the transmission lines and the grids and the sub-transistors and the copper cables. All that is ripe for investors. And I think sort of back to basics versus getting too attracted to the hype where there's just not an economic opportunity is the way to participate and support the transition.
Tamer, I mean, we talk a lot about India, having its decade now because of some of the also, I guess, red tape being taken out, infrastructure really going in, and some of the big changes. When is the right time, though, to get in for some of these projects?
I think the right time is now. There's a third largest producer already of renewables. Probably the pressure, coal is one of those elements of any investor's portfolio where there is obsolescence risk. India is one of the biggest coal producers. So that transition is happening now. I think the Indian government is very supportive of that transition. So that sort of intersection, Francine, of renewables and technology and building out this grid to allow these intermittent power sources to become much more central to India is a now opportunity rather than 5 years from now.
Again, is it difficult to know what section of the grid you want to be invested in, right? We're talking about it's modernization of infrastructure. It's also storage, I guess batteries. For a country like India, where do you play?
Yeah, we are a little less bullish on the storage and batteries play. I think lithium has a huge China risk and China component to it, and sodium batteries are still a way off. I think it's the grid itself. It's the transmission companies, the sub-transition companies. I think those vary less on what kind of renewable energy you're using. Typically, we also like to come in at the level of the parent company, so we're not necessarily financing a particular project, coming at the parent company, and we'd prefer to be on transmission lines that are closer to consumer centers, rather than there's lots of risk of building millions of miles of cables before you get the opportunity.
Tamer, you also talk about leaning into lower carbon fossil fuels while avoiding obsolescence risk. I mean, low carbon fossil fuel, I guess as an investor, it kind of gets bundled into one. So again, how do you rip out the bad stuff to keep the good stuff?
Yeah, there are probably two sides to that question. We should come back to big oil and, how should both ESG and other investors think about it. But our particular play within low-carbon fossil fuel is in, liquefied natural gas and LNG. And they're both small gas producers and large LNG producers who create the pressurization and the transmission and storage of LNG, which we think is still an untapped opportunity. And that's both on the equity and the debt side. And then I always, you can probably divide big oil between the BPs and the Shells who made more investment in LNG and have a bunch of patents on the renewable side versus, say, the Chevrons or the Exxons who've done less of that investment. But ultimately, I think all of them will become buyers of renewable technology created by smaller companies or by governments. The scalability and institutionalization of renewables requires big oil to participate in it. And I think they're going to be willing players. So you can't take your eye off them. You can't divest from them. I think engaging with them is critical.
And Tamer, I mean, given this in the kind of general context of, the cost of credit, cost of money going up, many questions about what the Fed does this year, where does it sit? Like, how much in terms of investment strategy are you looking at right now that could be volatile, a little bit like last year?
Yeah, I think investors are still very much in a sort of defensive crouch mode, Francine, and I think rightly so. The level of uncertainty, both geopolitical, with 60 major elections around the world, and with the amount of returns they can get in the short end of the yield curve at the moment, they're just kind of riding that wave. And I think whereas for a while we thought that just the stabilization of rates, which I think has happened in the EU, UK, US already, would get investors coming back, I think our view now, and as I talk to clients, is very much they want to see actual concrete evidence of rate declines. And I think we will get in the second half of this year, say in the US, at least two rate cuts. They're waiting for that. But I think there's going to be a major money in motion event for bonds when that happens, both because the yields are so attractive now after that kind of 10-year period of almost zero yields, and you obviously have the market upside over the long term as rates come down, which I think they inevitably will. Recession risk in Europe is only going up, not down. So I think that might be the first penny to drop in terms of rate declines.
So you're talking about a major event when the first cut happens. Are we underestimating that we could be in a different cycle? So even once the Fed cuts, it's not necessarily they cut almost at every meeting.
I think there are going to be less rate cuts, and the pace of rate cuts is going to be slower than the market thinks. And I think there are probably attractive opportunities right now, just given the yield. So we like the top end of structured products. We think kind of short-term investment grade is a good opportunity. But when that rate cycle begins, and I think in the US, the underlying economy is still strong enough that we're not talking about a deep recession risk, I think a lot more money is going to participate in that kind of gradual market upside in addition to the yields.
And do you think, Tamer, this is money that used to be on the sidelines? So is it cash?
This is money that has moved in a massive way into cash and money markets. And we see that in all the data. It's kind of sitting there I don't think 3 years from now, even 2 years from now, I suspect not even 8 months from now, will all that be sitting in cash. It's going to move, and it's going to move first into bonds, and then ultimately probably back into private markets.
When the ECB cuts, we expect June, is some of that money coming in already there, or are they waiting for the U.S.?
I think when the ECB cuts that money, we're already seeing it trickling in. I think it's just going to turn into a flood when all the central banks are in the same direction.
All right, Timur, it's great to speak to you again. Thank you so much for coming in. Timur Hyatt there, the Chief Operating Officer at PGIM. Coming up, SpaceX could sell shares that would see the company's valuation take off. Well, more details next, and this is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
The conversations that matter, the insights you need. This is The Pulse. I'm Francine Lacqua here in London. Now, Bloomberg has learned that Elon Musk's SpaceX is planning to sell existing shares at a price that values the company at roughly $200 billion. Now, let's bring in Bloomberg's Craig Trudell, who follows Elon Musk very closely. So, Craig, I don't know whether this is an Elon Musk story, because if he gets $200 billion in terms of valuation for that, he has a lot more freedom for investments, or whether it's more of a space conversation.
Yeah, I think it's honestly a conversation about, really SpaceX's very interesting approach to, being private and wanting to stay private. And it goes back for me to, the very public way in which, Musk flirted with the idea of taking Tesla off the market and of course, struggled to do so. But with SpaceX, they've done this somewhat routinely, really just offering employees and investors a chance to get some liquidity. And, it's really, I do think that all of these tender offers that we see from this company that have, become something of routine at this point just speaks to this idea that there is appetite and demand to invest with this guy, even as he struggles with some of his other enterprises, after his challenges with Twitter, now X, his recent issues with Tesla, that hasn't hurt appetite for whether it's SpaceX or XAI, which he's been out raising money for recently as well.
But Greg, and again, you understand, the intricacies of Elon Musk and the relationship he has with investors. If you're, participating in this tender offer, is this something? Are you buying into Elon Musk with, I guess, all the question marks that could entail, or again, is it a space play? I don't know whether his personality is questioned sometimes in his decision making at Tesla also translates to SpaceX.
I think there is, there is definitely, differing motivations between, whether or not you want to get behind SpaceX or an XAI. I think, there's nothing hotter right now than artificial intelligence, and, it doesn't particularly surprise me to see, him be able to go out and raise quite a bit of money at a pretty rich valuation for what is still a very new company. But with SpaceX, this is a very established company at this point that really has built, one of the more attractive, businesses in all of this sort of universe in terms of space. They really have a dominant position in terms of launch. The Starlink business has, of course, really become, a prominent player. And, I do think that, if you're going to invest in this, realm, this is, kind of one of the hottest companies around. And so, there are questions, I think, of whether or not, the valuation is maybe a bit rich. But if you can get behind this company, you become a sort of friend of Elon's.
Craig, thank you so much. Of course, Craig Trudell there with the very latest on SpaceX and Elon Musk. Coming up, Bloomberg Brief, Danny Berger and Manus Krani in New York, and this is Bloomberg.
The linear business is not going anywhere. The sports business is moving is going to figure itself out between digital and linear. It's an unbelievably healthy market. They all have to be in it. They all want to be. Every single one of the players want to be in it because of the audience. We have two assets in the sports business that are year-long, don't have a season. I don't believe prices are going down. You're going to figure out the bifurcation of the rights and give things up, not give things up.
How long do you think it is before Netflix actually jumps into sports?
They're in sports right now, but they just do the shoulder programming.
Yeah.
I think their point of view, and you'll ask Ted tomorrow, is we build up we don't want to be in the bidding of rights and then not have any long tail. So I'm not sure. They did bid on Formula One, but ESPN got it. So I think that was a smaller package, meaning smaller economics. So we'll see.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg.
Good morning from our global headquarters in New York. I'm Manus Cranny. Welcome to Bloomberg Brief. Let's set your agenda. Yields dip and stocks bounce. Back from the biggest loss this month as strong data pushes back the expectations of Fed rate cuts. The G7 finance meeting in full swing. Our interview with the EU Economy Minister Paolo Gentiloni coming up. And as Citi, HSBC and Barclays all call for 5 days a week in the office, citing new FINRA rules, well, we'll bring you the HSBC CEO's view on that here in the United States of America. So we're counting down to a interesting day. What did you learn yesterday? Which was don't fight the Fed. That certainly was it. From Bostic to the PMIs being the highest in 2 years. Not even NVIDIA, it could undo that sentiment as NVIDIA ramped by 9%. Bottom of your screen at the moment, you've got that little bit of a bounce back. NVIDIA was up 9%, $218 billion of a rally yesterday. But even NVIDIA rallying so couldn't invoke the spirit of a rally in the equity market. Definitely yesterday it was Jerome 1, Jensen 0 in terms of the markets. It could be the first weekly loss in 5 for the equity market. But looking at the bond market, what you've got is the twos popped by 8 basis points yesterday. So coming back ever so slightly, it was the data that won the sentiment. The short end was fearful. It was the tail that wagged the risk dog, really. There is a growing narrative of no rate cuts. And then copper. Remember Monday? It was at $11,000, up 40% in 3 months. It's the worst weekly loss since February. However, the skew is still bullish. So where are we with traders? They're certainly pushing back on interest rate cuts, with the Atlanta Fed President Raphael Bostic reinforcing the view that the central bank needs to be patient as growth is taking longer to slow than in previous cycles. Joining us now is our MLive correspondent, Noor Al-Ali. Noor, it was a rough day at the short end yesterday, to say the very, very least. And I love what John Arthur said. It was basically, you know, Jensen 0, Jerome 1, taking the PMI and, of course, the narrative. When you look at the bond market this week, do you think we're capped out at around 5%? Do you think that the pessimism on rate cuts is all fully priced?
Yeah, absolutely. And good morning, Manus. Look, there's a lot to take in here. The Fed appeared a lot more hawkish than we had originally anticipated, and the volatile swaps market didn't like that minutes reading that came out. Then the economic data came, and it was like a double whammy on markets here, because they had just come back and said, well, hold on. The Fed has been saying that we need to pause and just think about the very high inflationary dynamic that we're still in, that exceptionalism that we're seeing in the U.S. economy. Now, of course, jobless claims and continuing claims did point to the fact that maybe we're starting to see some weakness feed into the economy, but not to the degree that would warrant, you know, the 3 rate cuts that the Fed had originally jotted in March this year, and certainly not even 2 at this point. I think the question now is, do we even get 1 cut, or do we get a lot of holds and then potentially maybe 1 cut this year to carry us through into the next?
Listen, I thought it was quite interesting yesterday. NVIDIA was up 9%, yet the S&P 500 managed to end the day down. And if you'd taken out NVIDIA, which is 6% weighting in the index, it would have been a pretty hefty negative day. The chip stocks took a hit. They're trying to stabilize right now. But talk to me about the possible rotation that we're seeing. I mean, this NVIDIA results was supposed to be, a Damascene moment for risk, and it was far from it.
Yeah, absolutely, Manus. And this is a pivotal moment for markets. Yet again, we were hoping that stocks could continue to ride that NVIDIA rally and those gains and that optimism that we've seen in the past earnings cycles. Not this time, right? NVIDIA, as you say, rallied, as John Authors argued as well, and stocks didn't really reap those benefits. It's because that rate dynamic is still playing a big role into this. And, you had a size and scope there on stocks closing out lower this week. We've had, earlier remarks from different strategists throughout the market say that we're potentially reaching that sell signal. So there's a lot of caution in markets. There's a lot of fear as well that this higher rates dynamic is going to influence stocks eventually. But look, I mean, if you take a step back here, you'll see that actually yields are much higher because, and rates will continue to stay higher because the economy is actually doing quite well. And that will ultimately be good for stocks. So there's a lot of arguments here that you can say, but ultimately I think we're still in a good place for stocks, even in a short term. And a lot of people will look at the levels that we've come across now and they'll say, well, maybe this is a good re-entry point for me, at least for now.
I love what John Arthur, I would encourage everybody to go and read John Arthur's piece, because it's actually, you realize that's one smart man. Atlas shrugged as the bond market stole NVIDIA's thunder. And of course, he's referring to Atlas being NVIDIA, holding everything in terms of risk sentiment up. Look, the other market that I touched on was copper. Monday was $11,000. Here we are, we've given a little bit back. I mean, it was a parabolic move by any stretch of the imagination. The debate is going to be as to what extent this market has a supply-demand imbalance, and to what extent it's just at the beginning of a potential demand destruction, because the skew is still bullish.
Yeah, absolutely, Manus. And look, we're just talking about NVIDIA here, but remember, copper is very much on the long term an electric vehicle AI chip play, because copper is the kind of metal that is, the future of metals is really where copper is, right? When we talk about, for instance, oil really being a relic in terms of how demand is really shifting away from that, copper, however, has that long-term approach where, a lot of the gains that are currently coming in right now are pricing in that future of the great impact that this metal will have on the different sectors that we just discussed. But in the short term, the kind of short squeeze that we've seen here in copper is really reflective of the wider short squeeze, or the wider spikes in commodities that we've seen in recent years, right? It's a whole new dynamics that traders aren't really fully pricing in yet. And I argue about this in a column that's coming up later today, where I say that commodities have been spiking and kind of coming down. You've seen it in cocoa, you've seen it in sugar, you've seen it in coffee, and copper is one of those as well, but obviously each to their own, for their own reasons. And now the big thing is, are we at a point where markets and central banks will have to accept that inflation will continue to be higher, driven by these spikes? Or is it that we're at a point where these inflationary spikes that are led by commodities are a lot more temporary? So there's a lot more dynamics here that markets are still adjusting to, and it's incredibly interesting.
They really are adjusting, and we're going to hear from the HSBC CEO a little bit later on, and he made it very clear to me, look, get used to, we're in a different regime. We're in a different tariff regime, trade war regime, we're in a different rates regime, and if anything, the past 10 years were an anomaly on the rates regime. So get used to the new normal, which then takes us to the regime of higher for longer, and that is something that we're probably going to debate. With Torsten Slot talking about the lack of the transmission mechanism. We had the Peterson Institute, Adam Posen, with the surveillance team on Monday, even mooting the possibility again of a rate hike next year, and the folly of closing the door on that. When we look at the bond market specifically, Noor, it's still grappling, I would say, with what the length of real higher for longer is, because we vacillate between 2 cuts to practically no cuts, 2 cuts to sort of at less than 1 full cut in December. So I don't think that the long end of the curve is utterly convinced that rates are off the table.
Yeah, absolutely. And look, the dynamic that we're in today is not one that tells you, oh, central bankers are completely certain of the path that they're going to take forward. They've told us time and time again, they're cautious. They're going to be adopting a meeting-by-meeting approach. That's what the ECB has said. You know, that's what the Fed keeps pushing back against because, and even the BOE, even though they say, you know, earlier in the last meeting, the BOE did say, look, markets aren't really, you know, rates can go higher than markets are anticipating. But now you'll see actually, in fact, that even the BOE has said, look, we're closer to the Europe dynamic. You know, inflation is coming down. The economy is doing okay, or at least we think it's taken a corner. But still, markets are still not really certain. You know, yields have definitely come much higher. There's a debate here to be made whether they've fully priced in those expectations of easing much later or not. But ultimately, I think the question here remains, with that volatility that we get in bonds, how will that feed through into the rest of the, you know, the risk sentiment and the wider assets out there? The dollar is surging. Stocks are still quite resilient as well. Yes, they're not doing as much as well this week, but look at how many new record highs we've set in the U.S. equity market alone in this dynamic. So imagine a scenario where the Fed does start cutting rates, where a dollar does start coming down. What happens to yields then? And I think that's the room, and that's where the interesting debate begins on the different trades and the different types of strategies that investors would adopt.
Indeed, and we just had the PGIM CEO there with Francine talking about the money market funds and the very fast and furious flow of money that will come from that. He assumes that that will be a gusher of money and probably into equities. Noor, thank you so much for the coverage this morning. Our Bloomberg Live editor there, Noor Al-Ali. Other stories trending on your Bloomberg channel this Friday morning. The crypto industry is on the cusp of another major landmark. The SEC has approved trade products tied to Ether from CBOE, NASDAQ, and the New York Stock Exchange, opening the door for a spot ETF. Ether continues to gain on the bets that ETFs are coming. The Commodities Futures Trading Commission is ordering JP Morgan to pay $200 million for supervision failures. The regulator says the bank failed to properly monitor billions of client orders between 2014 and 2021. In March, JP Morgan was fined more than $300 million by the Fed and the Office of Comptroller of Currency over similar gaps. Over at Starwood Real Estate Income Trust, they're taking a drastic step, imposing tighter limits on investors' ability to pull money from the $10 billion fund. Now, the move is the latest indication that the higher for longer interest rate cycle that we're in is causing cracks in the commercial property market. Just months after ending 5-year hiatus, Boeing has again stopped delivering airplanes to customers in China. Now, this is a fresh roadblock in the company's push to restore its battered reputation. Separately, Boeing is said to be willing to, is still burning through cash this quarter and in the full year. Coming up in the show, we're going to catch up with Kyla Setter of State Street. Where does she believe the Fed is in the cutting cycle? Propensity to cut, we discuss. But first, we'll catch up with the EU Economy Minister, Paolo Gentiloni, from the G7. That's next. Context matters on Bloomberg.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We should definitely avoid any kind of trade war. Trade war is neither in the interest of the US, nor China, nor Europe, nor any country in the world. But nevertheless, we have an issue with the unfair trade practices, with the high level of subsidies, and with the industrial overcapacities. I'm the Minister of Finance. I'm also the Minister in charge of economy. And I will spare no effort to defend our industrial interests.
Defending the interests of French Finance Minister Bruno Le Maire speaking there at the G7. Let's get to the G7. Oliver Crook is on location in Stresa in Italy. The EU Economy Commissioner Paolo Gentiloni is alongside him. Oliver, good morning.
That's right, Menace. Thank you very much. And we heard Bruno Le Maire talking about China and trade and sort of equal playing field. That's one of the big topics here. The other big topic will be how to get that financing for Ukraine's defense on stable footing for the years to come. I'm very pleased to be joined by Paolo Gentiloni to talk about some of the main themes and things we've been discussing here at the G7. So let's deal first with this, the Russian frozen assets, how to go about dealing with them. Are we close to a deal and a compromise on how to use those assets?
I would say we are working on this in a very good atmosphere. From our side, the EU side, as you know, a few days ago, we finalized our proposal to dedicate the windfall profits from the freezed assets, and we will start to disburse to Ukraine the first tranche of this decision now in July. Then here we're working to try to maximize this and to find the best way to do this as fast as possible. Again, using the windfall profits of the assets. I think having seen the discussion in the G7 in the last months, I think we are narrowing the differences and we are addressing mostly the details of these decisions. So I'm confident that in the coming weeks we can...
So you think we'll have an agreement by the G7 leaders meeting?
I think at least a political agreement before the leaders G7 is possible.
And I want to also get your take on sort of what, how China, what sort of space that occupies in the conversations here. We heard Janet Yellen speaking about it yesterday. We heard Bruno Le Maire today. Is the G7 unified on how to sort of address the question of Chinese overcapacity?
But for sure, the G7 needs to be unified. To have a unified approach in the EU view, we need to strengthen also our mutual exchange of information, our monitoring, because to have a common approach, we also need to share information on measures to be taken. And this is, I think, what everyone around the table of the G7 is agreeing. Of course, we are, especially us, the European Union economy, we are very interested in a balance. From one side, we have to face Chinese overcapacity and industrial expansion. From the other side, we don't want that this de-risking compromise the advantages of global trade, which are very important for the European Union. So how to find this balance is very important, but I see unity in the G7 table.
And you think that you can get concretely, because the problem is that the U.S. can move a little bit faster, it throws up trade barriers, and then a lot of that overcapacity comes over to Europe. So how do you deal with that problem as the European Economy Commissioner?
But of course, we are not in the condition to know if there is a redirection of Chinese
But it's
to
happened,
Europe,
for example, in the solar industry.
Yeah. At the same time, the amount of electric vehicles that China is now exporting to U.S. is not so huge to make us have a threat that these are diverted to Europe. So the problem is not the immediate impact of this decision, but it is the principle that to have a united approach, we need to share information in the decision that we take.
And debt is the other sort of elephant in the room. It's something that obviously you're thinking about within the European Union. You're beginning sort of your infringement proceedings. How do you expect that to go within the EU? How do you get debt under control within Europe?
Well, we are not the one with the highest level of debt in the room. As you know, in the EU we have 83% of debt. But of course we have our fiscal rules that are back there, renewed, reformed, and they will address the high level of debt in some countries without, I think, creating problems to growth. The positive note is that finally the European economy is moderately, slowly, again in the growth path. This is very important.
But growing a lot slower than, for example, the United States, which is really causing some issues, particularly on the rate path divergence. What do you think the risk is to the European economy of the divergence between the Fed and the ECB?
Well, I think that the path of inflation decline could be different. I'm sure that the ECB will decide their monetary policy independently from what the Fed decide. At least I don't see any risk of a different orientation from the ECB in the short term. Then, as always, the ECB will decide on the basis of the data. But what the markets are expecting, I think it's realistic that in the coming months we will have a reorientation of monetary policy towards the declining of interest rates.
And a very quick question. There's been an election called in the United Kingdom. Could a different government, a government perhaps less hostile to the European Union, mean closer ties between Europe and the UK?
Well, closer ties are what we expect. I have to say that we reached a very good agreement with the existing government, but if closer relations are possible with a new government, we are very happy.
So some optimism from Paolo Gentiloni. He is the EU Commissioner on the Economy. Joining us here at the G7 meeting of finance ministers in Stresa, Italy. Manis.
Ollie, good to end on an upbeat note as you go into the political battle in the United Kingdom, and we heat up here in the United States of America. Oliver Crook on location at the G7. And don't miss our exclusive interview with the ECB Governing Council member Joachim Nagel. That is from the G7, 10:30 a.m. in New York, 3:30 London time. You just heard Gentiloni there talking about the divergence in terms of rates. Well, here in New York, the leaders are tackling a number of issues, including housing crisis and crime. Yesterday, I caught up with Catherine Wild, the CEO of the Partnership for New York, which is a business group composed of the city's largest companies. We started our discussion on the contentious issue of bail reform.
Bail reform is really not so much of an issue. We've got issues in what's called discovery laws that were reformed that make it very difficult for the prosecutors, for the district attorneys to bring a case. So we've seen dismissal of cases go up 50% on technical grounds because of the laws. And that's where the challenge is. And I think we're going to make sure that something is done about that in the legislature next year to try and get that fixed. But it is a small course correction. We actually have a very balanced criminal justice system, and we're working hard to make sure that we enforce it.
The second issue is housing. 95% of New York's housing is technically unaffordable for workers on average wages. So let's talk about big New York, not the top 1%. What more? There's no quick fix on this. But what more can New York and the city do in this regard? Converting older premises to housing, what are you advocating?
Once again, it took a little extra time, like 2 years, but we have now passed legislation which creates a new housing production program, which provides for, as we mentioned before, the conversion of older commercial buildings to residential. It provides for upgrading illegal basement apartments so that they're safe and sanitary. It increases the zoning allowances so that higher density housing, more units can be built. We are on track to address our housing problem. As you say, there is a lag time, but we're definitely on track. It is top priority. We want that young talent to be able to move to New York and not have to live 5 to an apartment. So we're working hard on that issue.
We're going into full electioneering mode between now and November. What is the sentiment? What is the partnership talking about in terms of the upcoming presidential election? Highest risk and highest opportunity?
Well, I would say the upcoming presidential election, we're a little worried that all of ex-President Trump's criminal trials have been brought in New York, or several of them. So that, you know, we're concerned that if he's elected, he not take it out on New York. Hopefully, because he's a Queens boy from New York, he won't.
Do you think he'd seek retribution?
I hope not. I'm just saying that's a worry in New York. But and then on the upside, our New York economy is doing well. We're driving the national economy in a positive way. And I want to say that we're the capital of finance because companies like HSBC, who are global giants, couple centuries of global giants, have chosen to make a commitment to New York, to move into a place like Hudson Yards, to invest here, and they're very committed here. So that's really important to keeping us a global financial capital, regardless of who's president.
What's the talk in the partnership about Jamie Dimon going to Washington? Would you be all cheering that on? Is there a discussion about that?
Well, we certainly don't want him to leave before his new building opens on Park Avenue, because that's a multi-billion-dollar investment in New York City, and we want to see J.P. Morgan safely ensconced in their new building. So, but we could do worse as our next Treasury Secretary.
Thank you very much, Kathy, for joining me on Bloomberg today.
Thank you for having me on.
There you go. Never far from a J.P. Morgan quote. Catherine Wild there, the CEO of the Partnership of New York, and some of the biggest issues on housing and crime here in the city. Coming up, we're going to catch up with Kyla Setter of State Street. She believes the Fed will cut rates. When and by how much? Those are the questions we'll put to her right here on Bloomberg. A very good morning from New York. Context matters.
Operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology. This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg.
This is Bloomberg.
From our global headquarters in New York, a very good morning. I'm Manus Cranny. Let's set your agenda. Yields dip, stocks bounce. After the biggest loss this month on strong data, pushing back the expectations of Fed rate cuts. The G7 finance minister meeting in full swing. Our interview with the EU Economy Commissioner, Paolo Gentiloni. And Citi, HSBC, Barclays, all calling for 5 days a week in the office, citing the new FINRA rules. Well, we'll bring you the HSBC USA CEO Michael Roberts' take on that very issue. Good morning. It's Bounce Back Friday. Don't fight the Fed. You know, good news was not good news for the rates market yesterday. And I love what John Arthur's had to say, which was, you know, Atlas, i.e. NVIDIA, holding up the whole equity market. Well, NVIDIA put on $218 billion worth of market cap yesterday, up by 9%. But the rest of the market struggled, and that may send you a signal of perhaps something else going on under the belly in equities. Are we near a peak? We can debate that in a moment. The short end of the curve actually popped by 8 basis points yesterday. The PMIs were the highest since 2022. It was an 8 standard deviation surprise. I'm going to say that again because that really shocked me. This was an 8 standard deviation surprise on the PMI. So that's what you call a robust economy. And copper, remember Monday? That was $11,000. That was 5 days ago. It's the worst week since February. Is it demand destruction or a reality check on the speculators in this market? By the way, the skew is still bullish on that. You've got NVIDIA at the bottom of your screen, just adding 0.2%. $218 billion is what we put on top of the cake yesterday for Jensen Huang. Well, the markets battled between NVIDIA and the economic data, and yields surged, seeing strength in the business activity at the short end of the curve, as I say, up by 8 basis points. Kayla Cedar of State Street writes this: the market is its own worst enemy. Until there is a clear trend that inflation is sustainably back on track to 2%, cut expectations should not be adjusted to September or sooner. I'm glad to say she's with me side by side this morning. Good to see you this morning. So if we look at yesterday, short end popped by 8 basis points. It was quite a reaction. I mean, I was shocked to see an 8 standard deviation sort of outsized delivery on the PMI. But you look at this, and again, the rate cuts got pushed back and less. I mean, are we living in hope of rate cuts now versus the reality of this economy?
Yeah, and thank you for having me. You know, I really think in terms of market expectations, the market we've seen this year really get ahead of itself a little bit. And I think sometimes that's really because of this ultimate faith that cuts are going to be, you know, the next move is going to be a cut. Yeah. And I think when we look at some Fed speak and even in some of the minutes, we are seeing some signs that transmission of policy is working and feeding through the markets. So yes, that means we're probably not going to see a hike next, but that doesn't mean we're going to see a cut anytime soon.
Can you tell me where you see the most manifestation of transmission mechanism? Torsten Slok was here the other day talking about a bifurcated society. Yeah. And so it's much harder. It's much harder to get the transmission mechanism through to the upper end of society versus the lower end of society. Where are you seeing the most impact of transmission?
certainly on the lower income spectrum. And I think that's why when we look at how inflation has adjusted over the last year or so, we're really not seeing much progress in terms of services or in terms of housing, especially on that housing front, right? So this week we got a bit more housing data, and even though the volume of sales is lower, actual prices continue to accelerate. And so I think that really speaks to some of the stickiness that we're seeing. And so going back to the consumer, yes, we've seen some progress on the goods side, but until we see more signs of more of the consumer adjusting their spending habits, which may not happen until and if we see labor market weakness, because they're not feeling it on the home front, right? It's really hard to get that transmission into services and into housing, which we need to see to get inflation back to 2%.
Which maybe goes to what Bostic's point yesterday, which was it's just going to take, higher for longer is just going to take a lot longer. You would say rates are capped out, short end of the curve are capped out at around 5%. What are the consequences of that?
I think in terms of equities for the summer, that actually could be a good thing if we're not going to see a bounce back up in yields beyond that 5% in two-year yields. So I think in terms of asset allocation, and we're seeing this in some of our proprietary data where we're seeing movement out of cash and back into the equity space, actually.
How would you describe the scale of that flow? Because that is the great debate, isn't it? Whether you go now, if you believe higher for longer will endure to the end of the year, are clients not tempted to hold on in these CDs, or what is the scale of, let's say, the movement from cash to equity?
I think part of that is where are you going within equities?
Yeah.
So sticking with the large cap quality growth, because really that's where we've seen seen the best performance in terms of being able to hang on to earnings growth, being able to hang on to revenue growth, things like that. And so that's really why we aren't tempted by some of the every now and then these upticks in small caps are broadening out. I think it'll still be pretty narrow.
What did you make of yesterday's action? If you look at NVIDIA, John Arthurs has this lovely line, which was, it was Jerome 1 and Jensen 0. In other words, NVIDIA was up 9%, market cap added over $200 billion, $218 billion. But the reality of it is, under the hood, you saw AMD, Intel, a couple of the other chip makers had less dramatic impact. But if you take out NVIDIA, there was not this euphoric kind of rush in the equity market. SPOOs were down on the day. It's the first weekly loss I think that we're going for in 5. So taking out NVIDIA, what did that say to you?
I think that's why we still see continued concentration. That's why we're not super excited about some of these more conservative I'd say lower growth parts of the equity market. One thing that was really interesting ahead of earnings is that we did see a lot of outflows out of the tech space because there was a lot of earnings risk and there was a lot of concentration. The bulk of earnings expectations were really concentrated to tech and tech adjacent. And so once they were delivered, we started to see those inflows again. And so, I would expect to see something similar within other parts of tech moving forward.
And just, and again, if Danny was here, I think this is homage to Danny, it's about small caps. You would say we're not at the bottom of the cycle.
No.
So you're not convinced. So if we're higher for longer, okay, we don't quite know when those cuts will come. You're not overly convinced on the size and the scale of the cuts. So therefore, you're still reluctant to buy small caps and breadth.
Yes, definitely. And I think, too, because of that, we're still, in terms of regional outlooks, we still actually like the U.S. better than other regions, even if it's an elevated for longer environment, because the quality of U.S. equities versus other regions, you still have high quality, relatively high growth. And so from a relative perspective in regional allocation, we still like the U.S., even though we might get cuts last.
And again, one thing that we've touched on this week is whether risk is stretched, whether the sentiment is stretched. In other words, Citi seeing some of the highest risk momentum in a couple of years. Do you get the sense that there's any level of exhaustion in this rally?
I think it's concentrated. And so because we're seeing selectiveness, that is a sign that, we're not in this huge risk-on environment, but we do have a risk-on bias. Because when we look at...
Is it risk-on or is it FOMO? Because that was the other one that I saw from Morgan Stanley this week, which was that the flow of money is more about FOMO than it is about actually really wanting to be involved in that market.
I think that definitely could be part of it, and I think it's all about relative choices, right? I think for now, equities are still attractive within that large cap quality growth space, and until we're continually seeing enough cuts to really stimulate other parts of the equity market, we're still going to be selective.
Okay, no, it's the barbell approach. I've heard it time and time again, which is tech to the left, and you're still holding that tech and cash on the left-hand side. Kayla, thank you so much for being with us this morning. Closing off what's been a very interesting week at the short end of the yield curve and equities. Kayla Cedar there of State Street. Coming up, SpaceX has $200 billion in valuation. It mulls selling existing shares. More on the story on Bloomberg. Context matters. Good morning from New York.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world right here on Bloomberg. Context changes everything.
It's Bloomberg Brief. I'm Menace Cranny with you in New York. SpaceX is considering selling shares at a price that could value the private company at around $200 billion. Tom McKenzie is with me. I'm looking at Elon's tweet from last night. SpaceX has no need for additional capital and will actually be buying back shares. We do liquidity rounds for employees and investors every 6 months. So, with that in mind, if he doesn't need the money, why is he doing it now?
Yeah, well, he's saying, look, this is an opportunity, of course, for existing investors and their employees, rewarding them, essentially, for holding on and being part of that ecosystem. So it does happen, he says, about every 6 months, and indeed we've got evidence of that. It happened about 6 months ago, but $180 billion was the valuation then. This time they're looking at selling, or at least the tender of shares of between $108 and $110 per share. So yes, it's a way to incentivize, of course, existing investors who want to maybe exit or at least capitalize on some of this upside that's come through, and employees. He says it's not about a capital raise. We've got plenty of liquidity. We'll be doing the buybacks. I think the reason we're interested, this is the most valuable privately held startup in the US. The way they've moved the dial so significantly across the space industry, and the fact that they could be listing potentially Starlink, part of the business, possibly by the end of this year.
When you see an Elon Musk story and then you look at the news conference that he had yesterday and how that was handled in terms of answering questions on Tesla and some of the issues around Tesla, around his remuneration, the domicile of the company. I mean, he has a lot of external issues going on at the moment. So what are we investing in? SpaceX or reputational issues with Elon? They are inextricably linked, aren't they? How do we get a piece of this? Because it was hot potatoes when I was in the Middle East. People were walking around going, do you know anybody that can tie me into a bit of SpaceX? I said, what do I look like, a broker?
Yeah, look, reputational risk is real, and it's something that existing investors at Tesla, some of them have flagged around concerns, particularly around his concerns, the handling of X. So that is a really legitimate issue. I think a lot of people would say, look, the team that run SpaceX are phenomenal, is what the argument they would make. They've got these multi-billion-dollar contracts with NASA. They've got the fundamentals. How you buy this, you either become an employee, you buy off an existing VC who wants to sell out maybe, but you have to be an accredited investor in the US. That means 2 straight years of $200,000 plus in terms of earned income, or a minimum of $1 million in net worth, not excluding, by the way, your duplex in Manhattan Manor. So that's one way. Or you get exposure via a fund that has some exposure to SpaceX. That would be another way.
Tom McKenzie, you lighten the day on a Friday, and at a mortgage rate of around 6.5% to 7%, the duplex will have to wait. Tom, thank you very much. Tom McKenzie in London, tracking the SpaceX story. The Biden administration cracking down on China with tariffs, and the world's 3 dominant economies are entering a combative phase. That was the narrative as I sat down and spoke exclusively to Michael Roberts, the US and America's CEO at HSBC, about how this may affect business.
Clearly, we're in a period of rising tariffs, rising quotas. Don't know what the Chinese response will be to the latest tariffs put on by the US. But, you know, trade liberalism is certainly in a different phase than it was in the past. So I think we have to accept that. Our companies have to accept that. So a couple of responses. One, we're there to provide that advice. We're the largest trade bank in the world. We have abilities to really help companies manage their trade wherever they may be. So if a client is exporting from China, as an example, and wants to move that production capacity outside of China, we can help them. We're the largest foreign bank in India. We're a significant bank in Vietnam, a very big bank in Mexico. So we're really there to help them navigate through this unpredictability. I think that'll continue. Regardless of what happens in the elections, we will have more tariffs, more quotas, a less easy trade environment to navigate going forward.
If I said to you, what's the biggest lever for the business in the near term?
Yeah.
Is it going to be rate cuts from the Fed or a clarity in politics and tariffs?
I think it's both. I think you need predictability. Companies need predictability to make their investments. Investors need predictability. What we haven't had really is that predictability. Lots of discussion on interest rates, lots of discussion of when and by how much. Now you've got the quota uncertainties. I think policy needs to be predictable. So if there's a rate cut, fine. If there's not, then it's the question of how companies then react to that. How do they then build their businesses to exist in a rate environment which is higher than it has been the last 15 years, but I would argue that the last 15 years have been an abnormal rate environment. So if they have that predictability, they can adjust their own production, they can adjust how they run their companies, and I think they'll do much better, but they need policy predictability.
But herein lies the point for the commercial bank. Let's just square that away, which is, many people say to me they've refinanced a great deal, have refinanced on the retail private side.
Yeah.
Do you think that's the same for corporates? Are they holding back on doing deals, doing M&A, doing debt capital markets as a result of uncertainty?
Yeah, I think they were in the past. I think last year was certainly a reflection of that uncertainty.
And we've jumped over that now.
We have jumped over it. If you look today, the capital markets are on fire. We've had $750 billion of issuance in the debt capital markets for investment grade. Spreads are the tightest they've been in a long, long time. a lot of CLO formation of capital for the non-investment grade market, which I think will continue. And even the equity market, we've seen a lot more IPOs, led by the tech sector, of course, but IPOs are trading very nicely now. A lot more activity. So I think that sense of predictability is coming back.
So you would say no cuts in America in jobs in those businesses?
I would say we're fit for purpose, and we will always, change, we'll always react. It's a dynamic process, but we're fit for purpose.
To accelerate that bump that you've had in business, do you think rate cuts will re-accelerate that? I know you're on the table for limited cuts, but do you think a shift in the rate environment can materially shift the business?
I think rate cuts will be important, but not determinant. So I think, yes, it's important to have rate cuts. Again, I'll go back to this predictability statement. If rate cuts come, it provides predictability. I think you'll see the capital markets grow even more. I think they're poised to do so. As I mentioned, lots of capital formation, money sitting on the sidelines, but it wants to be put to work. So as soon as we can see predictability, I think you'll have even greater growth in the capital markets, both debt and equity. And I think we're well positioned to take advantage of that. We've got lots of discussions going on. Lots of sentiment is turning positive today.
Do you think it is better culturally for the people of HSBC to have an internal person versus another new person come in?
Yeah, and look, I think we've got a lot of good internal candidates. I think there clearly is an advantage for having someone who knows the institution. I think the board's going to take that into consideration. They already had a succession plan worked out. They were very focused on making sure that they would have a very quick, efficient, and very targeted succession plan. They're looking at both external and external candidates. Their decision, obviously. But I think, very important that you bring the right person in who has the right culture, the right mindset, and the right set of skills.
We have one debate going on in New York about getting everybody back into offices, back into trading floors. FINRA are fighting back, saying, look, we're offering flexible working. You're probably one of the most flexible banks in the world. How do you see that for Wall Street? How important is it for Wall Street getting back in 5 days a week? What do you say to that?
Yeah, so FINRA has, as you mentioned, changed the rules, and we're adjusting accordingly. And we're going to follow the rules like everyone else. We are a hybrid bank. What we did not want to do is to force people to come back simply at a decree. So what we did is we built a building, this building, Hudson Yards, in the financial capital of the world, which really reflects a lot of input from our employees of why they want to come to the office. Because we did this during COVID, and we didn't know if anybody ever wanted to come to the office again. And so we built something that is very, I think, conducive to people coming back. They want to come back. And so today, our overall attendance levels are at 80%. Before we moved, less than 40. We're running out of space very quickly, and luckily we just took some additional space in this building. So I think we will adjust to the FINRA rules. We'll make sure that whoever needs to be here 5 days a week will be here 5 days a week. But I don't want to decree people coming back. I want them to come back because they want to come back. And they do so, and they're productive, they feel good about it, and that's essentially the environment we have built today.
And that was Mike's sister conversation with Michael Roberts at HSBC. He doesn't want to decree that you've got to be back in the office. And a mighty fine space in Hudson Yards it is too. Coming up, a little bit more Fed speak and Treasury market. Closing early for that 3-day weekend. We'll discuss what's on your slate. Context matters on Bloomberg. Good morning.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
I think that the path of inflation decline could be different. I'm sure that the ECB will decide their monetary policy independently from what the Fed decide. At least I don't see any risk of a different orientation from the ECB in the short term. Then, as always, the ECB will decide on the basis of the data. But what the markets are expecting, I think it's realistic that in the coming months we will have a reorientation of monetary policy.
EU Economy Commissioner there, Paolo Gentiloni, speaking to Bloomberg a little bit earlier. And we will bring you full coverage from the G7 later this morning. The ECB Governing Council member, Joachim Nagel, joins the team at 10:30 a.m. Eastern Time. Stay tuned for that. Let's set your agenda for the rest of the day. Before you leave for Memorial Weekend, Fed Governor Christopher Waller will speak at 9:30 a.m. Eastern, and we get durable goods at 8:30 a.m. plus University of Michigan Consumer Sentiment at 10 a.m. All eyes time for that. Treasury market closes early, 2 p.m. That is for your Memorial Day holiday. Some micro movers for you at Workday Syncs. They're cutting subscription revenue guidance, also delivering mixed first quarter results. Keep an eye on Intuit extending its decline on weaker than expected outlook despite raising its full year revenue. And then AMD, keep an eye on this. You know, a number of the chip makers had a really, really tough day yesterday. AMD was down by 3%, along with Intel, along with a number of the other chip makers. So there is some reprieve there this morning as NVIDIA added 9%, $218 billion in equity capital value yesterday. And of course, Dan Ives says we're at the beginning of a new tech bull market. We're up an eighth of 1% this morning from myself and the team here on Bloomberg Brief. Have a lovely long weekend for Memorial Weekend. If you're traveling, enjoy it. And surveillance is up ahead. Context Matters on Bloomberg from New York. Good morning.
look at the number of women that want to learn the game, young girls that are joining on the tee, really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing, but what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, to dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
As an asset allocator, I don't think I've ever been so interested in stocks.
Corporate health looks very good right now. We do feel very good about that.
The momentum continues to get even stronger than it had been earlier this year.
Everybody is trying to get into the AI world. The question will really be who ends up using it better.
Get the popcorn out, because this AI revolution in 1995 moment is just starting.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
It was supposed to be a quiet end to the week. It really hasn't been. Good morning. It is Friday, though. Welcome to Bloomberg Surveillance. If John were here, he'd say, let's get you to the weekend, and we'd all cheer. He's already on a well-deserved break. Anne-Marie is here, maybe with suitcase in hand. Danny Berger pulled the short straw. She's kind enough, as always, to put up with us for 3 straight hours. I think Ian Lingen really put it the best. Yesterday, he said, we came in today's session, yesterday, assuming that the only thing more boring than Thursday before a long holiday weekend would be Friday morning. Alas, the price action proved to be far more exciting than anticipated, Danny, with a stronger services PMI print as the most readily identifiable trigger. Danny, what a mood shift starting yesterday around 10 a.m.
I think if you had told anyone that some second-tier data of PMIs would trump NVIDIA, and they had said, yeah, I believe that, they would have been lying. There's no way. We all thought NVIDIA would be the big macro event. So what happened? Were we too one-sided? Is it because FedSpeak got us nervous before this data? Is it the AI pie can't possibly lift all boats? I don't know what it is, but it feels like a big sentiment shift.
Anxiety around inflation. I put this to Chris Williamson, the chief business economist at S&P Global Market Intelligence, says companies remain cautious with respect to the economic outlook, uncertainty over the future path of inflation, interest rates also, citing worries of geopolitical instabilities and the presidential election.
Given this, pulling back, there's this feeling that today's actually 10 a.m. University of Michigan sentiment survey once again matters. Yes, they may pull about 500 people online through instant messages or whatever else they do. At the same time, should people start to really have deteriorating sentiment, Emery, there is a feeling that this is going to have a bigger impact on people's views going forward, not only of how hard it is to kill the inflation boogeyman, but also politically.
So we see in the earnings report, Starbucks, Walmart, Target, trading down, trading in, looking for those cheaper products. And then we have Janet Yellen, who's in Sintra, meeting with other financial chiefs around the world at the G7. This is what she had to say to the FT. She talked about the concern, trying to be empathetic where the American consumer is right now. And she says they see it when they shop for food in terms of rentals, higher mortgage rates. It's tough for young people who would like to get on the housing market to enter this market.
At the same time, I feel like that's a little bit more sympathetic, a little more empathetic than what we've heard from Biden. Biden has had this tone that's almost like, look, I know you don't think the economy is good, but we know it's good. We know it's better than you say it is. I have to say, looking at the U.S. PMIs yesterday really did show us that for businesses, they are doing well despite what business sentiment says. So even that shows us, okay, take these sentiment surveys with a grain of salt.
Business activity coming in at the fastest pace in 2 years. Looking at prices paid, and this was sort of the rub, coming in at the highest pace since 2022. Raising this question, everyone was expecting that services inflation would come down to goods inflation. We are seeing it potentially move in the opposite direction. That, to me, is part of the rub. I do want to just bring this. Yesterday, we really were thinking it was all going to be about NVIDIA really lifting all boats. And then we did get this inflation read at a time where you do have a lot of people looking for a cool-off. Michael Hartnett coming out this morning, Danny, saying the rally in global equity markets is at risk of overheating. Barclays talking about how it's starting to look tired. How realistic is that?
I think that you saw some of that yesterday when, by the way, not just non-AI things sold off, AI things sold off yesterday. AMD, Intel, they fell more than 3% yesterday. If NVIDIA is the AI tide lifting only AI boats, it didn't even do that. And utilities, Lisa, I know you've been talking about this so much. They were hurt a lot yesterday, too. I mean, that to me seems like exhaustion.
Which led to the biggest sell-off in both the S&P and the NASDAQ of May. You see that biggest decline, of course, particularly in the Russell 2000 yesterday, going back to the end of April. Here's a state of play, a little bit more optimistic, up about 0.25% to start the trading day, a little bit less than that on the S&P. You could see a little bit of dollar weakness, been toggling around here for a while, basically steady at the 108.31. You could see 10-year yields just a little bit lower, but yesterday really climbing on the prospect of potentially some sort of ratcheting back of expected rate cuts. Coming up, we've got Lee Farage of State Street as U.S. stocks pull back from record highs. Bloomberg's Craig Trudell as Elon Musk rejects tariffs against China. And Ian Shepherdson of Pantheon on the global economic outlook as leaders converge, as Anne-Marie was talking about, at the G7 in Italy. We begin with our top story, U.S. stocks easing from fresh records despite 9% surge from NVIDIA. Investors looking ahead to another busy schedule of U.S. data next week. Lee Farage of State Street writing this. If we do see higher inflation prints for May and perhaps June, then one cannot ignore the prospect of the next move being a rate hike. It is a bigger tail risk now than it was just a few weeks ago. Lee joins us now. Lee, good morning. Thank you for being with us. I want to just start with what you made of yesterday's price action where NVIDIA's blowout moonshot couldn't overwhelm even the slightest tick up in the prospect of goods inflation.
Yeah, thanks for having me. I think what yesterday showed to me is the balance of risks in the market have now shifted. So before, you'd see a bigger reaction to positive news to the market, be that, lower inflation or be that, some sort of sign of a slowdown in the economy, which would seen as setting the path for the Fed to cut rates. That would cause a bigger market reaction than stronger data, because stronger data, well, it's coming, the slowdown's coming, the Fed are going to look through this. Yesterday showed me that balance of risks in the market, in the mind of market participants, is shifting. The Fed have told us now they're going to need time to trust the downtrend in inflation again. Is that 2 more prints, 3 more prints? We don't know, but they've told us they're going to need time. On the other side of the equation, if you get strong data from here, you get a strong inflation print, how quickly does that feed into the Fed actually starting to think about hikes, which, various members in the minutes, we saw what they said on Wednesday, various members said they would hike rates further if the data warranted it. And I just think that balance of risks and the way we react to data has shifted over the last few days.
Lee, you've had a positive bias to risk assets, in particular to equities. How much was the price action yesterday instructive of just how at risk equity valuations are to the idea of faster inflation and the prospect of a rate hike being back on the table?
Yeah, I think it's become a real prospect, as I wrote in my notes. Look, a hike is still a tail risk. It's not a central view. I would put it 25%, okay, which is probably much higher than probably a lot of people would put it, but still a tail risk. But it's there. And, the Fed have openly talked about hikes. They haven't mentioned the hike word for a year, but now they're starting to talk about it. And I think that vulnerability is now there in the market. Look, central view, I still think, data, if it's okay over the next month or two, as long as the market believes the next move is a cut and believes we're entering a cutting cycle, then I think risk assets can continue to perform well for the next month or two. But it's going to get more volatile, I think. We're going to see more days like yesterday. Overall, probably uptrending tax, but we're going to get more days like yesterday. And if the market really does start to believe the next move could be a hike, then that's going to signal the top in the market for me.
Lee, but what about this idea that even if policy was to remain tighter or even get more tight, the reason it's doing that is because of economic strength? And if it's because of economic strength, then equities are okay because earnings are okay. Is that not the case anymore?
Yeah, and that's been the narrative all year. We've pushed back. Don't forget, at the start of the year, we had 7 cuts in for this year somehow. And the first move was meant to be in March, and that all got pushed back, and equities were up 10%. Because it was extend and pretend. We were pushing out the rate cutting cycle. We didn't take the rate cutting cycle away. We just delayed the start because the data was so good. And as long as we can keep doing that over the next month or two, then stocks will be fine. But if the market really does sit back over the next couple of months and say, are we right about this cut? Are we right about this cutting cycle? If the Fed signals they need to hike, why are they signaling they need to hike? Because they need to slow the economy more to get inflation back to target, to get it trending back to target. So soft landing sort of goes out the window because the Fed is saying, look, this isn't working. We need to slow this economy a lot more. We need to hike rates. And then suddenly that argument that stronger data is good for markets suddenly doesn't look as clear-cut as it was before because stronger data means the Fed have to do more.
Well, Lee, let me give you the other argument then of why stocks aren't vulnerable and why they can be more resilient, is that it's AI. It's AI come to save the day. Perhaps yesterday proved to us that that's not necessarily the case. If something like AMD is also falling with NVIDIA, is that trade also tired out, that in AI is a rising tide that lifts all boats?
But we've come a long way. The AI story has come a long, long way. Look at where NVIDIA is. And no, I don't think the story's played out. I think there's further to go. And I think AI-specific stocks will continue to outperform. But the rest of the market is going to struggle to continue to play, as you say, play that sort of AI rising tide. And I think that's what we saw yesterday, even with NVIDIA having a great day. The rest of the market could not go with it. So I think the whole thing that AI is going to lift everything, I think that story's run its course. Not AI specifically, but the boat that's lifting everything. I think that story is looking very tired now.
Lee, if we can go back to your tail risk about the hike, you're the second person this week to come on this program and talk about that. We had Adam Posen on, and what he was concerned about was the fiscal impetus going into next year, how much spending we're going to get from Washington. Say we do see a lot more spending in 2025, tax cuts, another fiscal package. Potentially there's going to also be tariffs that can be inflationary. What kind of vulnerability could we see from that idea of a hike?
Tremendous. I mean, we've come a long, long way. If the market really believes that the Fed has to hike to slow the economy, then yes, I think you are going to see a fairly significant pullback. Look, we've come a long way. Even if we pulled back 10%, we're still flat for the year. And I don't think it'd be that much more than that. But a pullback of that magnitude, if the market starts to price hikes, is fully possible. And look, the fiscal thing is important because everyone's sort of assumption is on rate hikes. Policy is restrictive, therefore the next move has to be a cut. Well, look, rates are above neutral for sure, although not as far above as we thought. I think neutral is probably 4 to 4.5% nominal, and the Fed sort of hinted that they believe that rates aren't as restrictive as they thought the other day. But policy isn't just rates. Policy is made up of the level of interest rates, the size of the Fed balance sheet, which is still significant and bloated, and fiscal policy. And you take those together as a combination. Policy itself is not restrictive, and that is what the data is telling us. That is why the US economy is growing at 3% year on year, close to double the Fed's estimate of trend growth. If policy was restrictive, we wouldn't be growing the way we are. Policy is not. Rates might be above neutral. That does not mean that policy overall is restrictive. So if you loosen fiscal policy further next year, by definition, you have to tighten it somewhere else. And the only tool that really you can do it through is higher interest rates.
Lee Farage of State Street, thank you so much for that. We've come a long way, which really kind of echoes the sentiment that we heard from Michael Hartnett. Risk of overheating and Barclays looking tired. Right now, let's get you an update in stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Hakis. Yahaira.
Lisa, NVIDIA CEO Jensen Huang had a good day yesterday. His net worth grew by almost $8 billion to $91 billion as shares of NVIDIA rose 9% following better than expected quarterly results. A majority of Huang's net worth comes from his stake in NVIDIA, which he co-founded back in 1993. According to the Bloomberg Billionaires Index, Huang is now the 17th richest person in the world. Elon Musk's SpaceX has initiated discussions about selling existing shares in a deal that could value the company at $200 billion. That's according to people familiar with the matter. The valuation would be a premium to the $180 billion it fetched in its previous tender offer. SpaceX is already on par with some of the world's largest publicly traded companies by market cap. And hundreds of students walked out of Harvard University's commencement ceremony yesterday. This in protest of the governing board's decision to withhold degrees for 13 students who took part in a pro-Palestinian encampment on campus. A mix of graduate and undergraduate students stood up and chanted as they left in the middle of the ceremony. They continued to protest within earshot while the ceremony continued. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. And aside from that, congratulations to the graduates. Just on a more general note, up next, Tesla pushing back on tariffs.
Tesla competes quite well in the market in China with no tariffs and no differential support. In general, I'm in favor of no tariffs.
That's next. You're watching Bloomberg.
Could face bigger challenges next.
It was going to keep rating World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars. Only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
After the biggest sell-off so far this May in about 3 weeks, we are trying to claw back a couple of, at least a bit of those gains. You could see about 1/4% gain on the S&P in early trading. You could see a little bit of dollar softness. Again, a risk-on tone as people look to potentially both stronger economic data as well as maybe a Fed rate cut coming in September. Under surveillance this morning, policy and front focus, Tesla pushing back on tariffs.
Neither Tesla nor I asked for these tariffs. In fact, I was surprised when they were announced. Tesla competes quite well in the market in China with no tariffs and no differential support. In general, I'm in favor of no tariffs.
Here's the latest. Elon Musk criticizing the recent tariffs announced by the Biden administration on China's Chinese-made EVs. Musk saying he favors no tax incentives for EVs while avoiding a question on whether Tesla would bring a cheaper model to the public. Bloomberg's Craig Trudell joining us now. So Craig, riddle me this. On one hand, what people say in public feels a little bit different than what they might say in private. How difficult is it for not just the Elon Musks of the world, but the BMWs and the Mercedes of the world as they face off with the Chinese threat?
I think it's a great question because BYD has proven extremely competitive, and it's not just me saying that. I mean, Elon Musk was saying that and has repeatedly said that, quite recently. I think, in January, he was asked about, just how tough the Chinese are, and he, said that he thinks that they will have significant success outside of China, depending on what kind of tariffs or trade barriers are put up. And so, while he said yesterday that he was surprised by this, I don't know that I necessarily believe him in that. This has been well telegraphed, and he himself has referred to this idea that, if trade barriers are not established, that they will really give, the likes of BMW and Tesla a real challenge.
So, Craig, how much is this political? We know that Elon Musk has kind of weighed in on the political sphere, and how much is this purely out of business interest, given the fact that Tesla's got a significant presence selling in China, as well as BMW, as well as a lot of the German auto manufacturers?
I think that absolutely has to be coming into play here because, he referred to this idea of, no tariffs in China, which is silly. There are, tariffs. China does really kind of insist for the most part on you producing locally. He also referred to this idea that, Tesla hasn't had preferential treatment, which also is a questionable claim. They were the first foreign car company to be let into China that didn't need to set up a local joint venture with a local manufacturer. So, Tesla has, gotten some help in China. I think it also is just, the case that Tesla has significant business there exporting to other markets, and Musk would rather not see, a sort of escalation of tensions between China and the U.S. or China and Europe. And, here in Europe, he's quite reliant on the Shanghai factory, sending over Model 3s. And, he is making some Model Ys in Germany, but this is absolutely the case that his plant in China is, their export hub.
Craig, when it comes to Europe, we heard from France's finance minister earlier this morning, Bruno Le Maire, talking about the overcapacity and concerns with China and saying that there needs to be, quote, a united front when it comes to dealing with China. He's speaking alongside G7 partners. What is Europe's plan right now? Where are they in this process of dealing with China's dumping on their market?
Yeah, we're only weeks away from, getting a better sense of, what exactly the next step is that Brussels is going to take here. I think, there's a general sort of, consensus or assumption that tariffs will go up. I think, the Chinese manufacturers, saw this coming and actually have been, kind of conservative in terms of how they've priced their vehicles. There have been quite a lot of EVs coming into Europe from China. But, when you actually take a look at what, say a BYD charges for its vehicles in Europe, they're quite a bit more expensive than they are in China. And, some of that, of course, is, localization differences and perhaps slightly more robust, crash worthiness, because there is, there are higher standards for those sorts of things in Europe than there are in China. But I do think it's been the case that they were trying to avoid this sort of clash and just weren't able to, because even a sort of, initial, bit of exporting from China, without a huge amount of success, was enough to really set off alarm bells. And to the extent that we have seen some success, it's been Tesla exporting from Shanghai, and it's been MG, which is owned by a state-owned company and used to be a British brand. And so a lot of Europeans kind of assume that they're buying a British car when in fact they're buying one from a state-owned Chinese company.
Tesla was also out with their 2030 report. Do you get the sense that Tesla is prioritizing autonomy over the market share and the core car business?
I think, it's clear as day at this point. Yesterday, Tesla putting its impact report out, the last couple of years, they alluded to this idea that they wanted to sell 20 million cars by 2030. In order to do that, they're going to need to offer much cheaper electric vehicles. And we've seen, one indication after another the last, couple months that Musk is less interested in that pursuit and wants to really sort of double down and focus more heavily on autonomous driving. And that's been something that even, very bullish Tesla investors have been nervous about, because we've seen real issues with companies, running into problems with trying to commercialize that technology. It has a lot of promise. It's been something that, a lot of people have been very interested in, but the, nuts and bolts of getting these onto the road and dealing with potential crashes and the costs of bringing this to market, it's proven much more difficult and maybe a several year, even decades phenomenon, as opposed to something that is going to be ready for prime time soon.
I have to say, Craig, it's pretty incredible that at Viva Tech, he basically avoided or answered indirectly all questions about this, all questions about whether he's still committed to low-cost vehicles. But it was only a month ago in his earnings, he literally talked about their growth mostly being underpinned by low-cost vehicles. What Musk are we supposed to believe in?
I do think, there was more than a few contradictions in what he was saying yesterday. My assumption is that he was sort of hearing yesterday's question is really more so alluding specifically to this idea of a standalone, brand new $25,000 Tesla. A lot of people refer to it as the Model 2. And I think that car is just not, a priority for him. Again, he wants to, go the self-driving route instead. And I think, reading between the lines of what he said on the latest earnings call, it really just sounds like they're working on, taking some of the development that work that went into that $25,000 car, applying it to their existing lineup, and spinning that as we're going to offer more affordable electric vehicles as soon as late this year, but leaving out the particulars, which I think it means that we're going to see a cheaper Model 3 or Model Y late this year or early next year.
Craig Trudell of Bloomberg, thank you so much, as always. And it's always a little confusing to know which Musk to listen to, as it can sometimes be contradictory. Coming up today, we do have a little bit of economic data in an otherwise light day. We have data at 8:30 a.m., durable goods. At 10 a.m., we get University of Michigan sentiment survey, as well as a look ahead for inflation expectations. Right now, what you could see in markets is a lift. Maybe the AI theme isn't as tired as people think, with the year-to-date gains on Alphabet and Meta up more than 24%. We'll talk about some of their issues with AI. This is Bloomberg.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
Closing out a week before a long weekend, it is supposed to be boring. It isn't, because of what happened yesterday with the blowout from NVIDIA and then the add-on to a higher than expected inflation reading as well as business activity. Today, good news yesterday is good news today, at least on the margins, about 0.25% lift for the S&P, trying to claw back some of the losses from yesterday. On the NASDAQ, up about the same again. Sort of surprising that even with the NVIDIA gain of about 9%, we still are seeing the NASDAQ down yesterday, the most in 3 weeks. The Russell, to me, I mean, honestly, Danny, this to me has been one of the biggest mysteries. When is the Russell going to finally get a bid? It seems to be entirely dependent on what's going on in the bond market.
Yeah, I had this aha moment talking to Max Kettner at HSBC, who basically said 40% of small caps are floating rates. They have floating rate debt, so they are extremely exposed to higher rates. So as good as the economy may be, they can't rally until there are cuts.
Which is the reason why everyone's focused on the bond market, including Mike Wilson of Morgan Stanley. When you take a look at 2s, 10s, and 30s, you could see today a bit of a bid after yesterday's sell-off, pushing the two-year yield to 4.92%. Again, just creeping closer to that 5% threshold over the next 2 years, with some people, including Lee Farage earlier, talking about potential rate hikes. 10-year yields 4.47 rounded up, and 30 years 4.58%. In the commodity space, you can also see a bit of a decline, at least in oils. But with the currency levels, to me, what is fascinating is this question in the Eurozone of just how much they can cut rates. And Marie, I think this is fascinating, given the fact that we had expected them to cut rates in June. That's pretty much a given. But increasingly, some better than expected data, in particular wages negotiated, pushing back some of the expectations of how much they can cut this year.
And does that mean that they actually do have inflation under control if you see wages going up? Does this spell potentially a June and hold environment? Because let's be honest, Christine Lagarde basically said this week, it looks like inflation is at a place where we can make that first cut. They have been talking about it since when? We were at Davos in January, that June cut on the table, everyone's expecting it, but what happens after is the real question.
Isabel Schnabel of the European Central Bank this morning came out and said that a possible June rate cut would be a compromise, and talked about why after that it's going to be somewhat challenging. All right, under surveillance this morning, Treasury Secretary Janet Yellen is set to meet with ECB President Christine Lagarde at the G7 today. The conversation coming after new comments from Yellen on inflation and tension with China. Yellen saying she wants a, quote, wall of opposition to counter China's state-driven policies. Anne-Marie, what a shift, given how much she embraced some of the globalization narrative earlier.
Yeah, we've seen a shift with Janet Yellen over the past 3 years as Treasury Secretary. What's interesting is the Biden administration really has wanted this multilateral approach when it came to China. I'm struck by Bruno Le Maire's comments this morning, the finance minister over in France. He's talking about China's industrial overcapacity and how the G7 must present, quote, a united front to protect industrial interests. Well, it was only a year ago when Emmanuel Macron gave this pretty stark interview with Politico, and he talked about the fact that the great risk Europe has is actually there is a crisis and it prevents them from having their own strategic autonomy. So my question for Europe would be, well, which one do you want? Do you want the united front, or do you want the strategic autonomy?
Well, there's some bit of irony of Yellen asking for this, of wanting this united front. If you look at how the G20, the G7 rundown basically went yesterday, you had all of these speakers from Europe. You had Le Maire talking about economic lethargy. You had Villeroy saying the U.S. is much stronger than us, we're struggling. And then Yellen basically coming out and saying, actually, the global growth is really good because of us. You're welcome, world. Of course, she didn't say that exactly. So for her to say that and say, we have really strong growth and that Europe is complaining, and then on the other hand say, we need a united front against China, I mean, surely she sees some of the contradiction in that.
There's also a contradiction in her wearing the economist hat and her wearing the political hat at a time where it's very difficult to parse both the idea that inflation is about 19% higher than when Biden took office in the United States, while also that on the margins, economic data points to a deceleration in inflation and some of these more, complicated metrics to really grapple with when you're facing off in the grocery store.
I think with Janet Yellen, if she puts her economist hat on, she would say something like, yes, tariffs are inflationary. If we really want to fight inflation, want to pull every lever, get rid of tariffs. But she's moved into this national security sphere, and she's been concerned. She's been talking about her concerns of what is going on with China. And that's when I think she gets a little bit more comfortable with talking about things like tariffs.
This is our favorite story to talk about, this particularly ahead of Memorial Day weekend travel. More trouble for Boeing. The company saying it will halt deliveries to China just months after a 5-year hiatus came to an end. The stock plunging yesterday, yes, again, after the CFO said the company's cash burn would be similar or worse than almost $4 billion in the first quarter. How much, Danny, is this politics and how much is this actual concern about safety?
I mean, can you imagine if all of a sudden Boeing is also now caught in the crossfires of politics, of Chinese-U.S. politics? I mean, it's like every single global trend plus your own internal problems that can gone wrong. At this point, it feels like death by 1,000 cuts by Boeing. And I can't help but wonder, at what point does the U.S. government look at this and say, Boeing is supposed to be this national champion? It is so important. If it keeps going this way, at what point do we need to start talking about some sort of bailout? Maybe not in the traditional sense, but something to help them if they keep going down this trajectory.
At the same time, how about just understanding what went wrong? Understanding why we're not necessarily getting to the bottom of some of these problems. Anne-Marie, I do wonder what this says also about industrial policy. Basically, a state-orchestrated monopoly on an industry that is so crucial, not only to just flying around on vacation, but also to defense.
Absolutely. Boeing, and I think we've heard this a few times from a lot of our guests, too big to fail. When it comes to potentially more information, we're going to find out they will be briefing the FAA on June 4th. So potentially we'll know a little bit more of under the hood what went wrong. When it comes to China, this is a massive blow. They only started to send some of their planes back to China earlier this year after, what, a 5-year hiatus, nearly? This is a vital cash juggernaut for Boeing. And the fact that that's being stripped out, it's just yet another problem on the long list.
At least it's not a safety concern. So enjoy your Memorial Day weekend. Meanwhile, Alphabet and Meta are offering millions to Hollywood to partner on artificial intelligence. Bloomberg reporting tech companies have held discussions over licensing content in order to create better video generation software. Disney and Netflix have denied the requests. Warner Brothers Discovery is still weighing a decision. Bloomberg's Alex Webb joins us now. I love this story, Alex, because it raises this question of, with all of the artificial intelligence models, and I want to go here before we broaden in specific to this story. How much are they relying on the content generated by humans in companies that are not benefiting in any way, shape, or form economically from what the output is from the likes of ChatGPT?
The risk here is, of course, that you get a little bit of money up front, but ultimately it could come back to bite you further down the line. It could also help you in a sense if you're wanting to generate, computer special effects, VFX, essentially, with this kind of stuff. But the complexity, of course, is that, yes, there are people in a lot of these videos. How are they How are they remunerated? Are they getting additional pay from the fact that maybe their likeness is being trained on this? Presumably that's where some of the complication lies. From the OpenAI side, this is really about how do you find the next wave of data to train your next generation of, GPT-5 or whatever it might be called. Because the estimates are that GPT-4 was trained on about 1 trillion parameters, essentially 1 trillion data points. How do you find more? That's potentially the whole internet. So they're really in a search now to find new sources of data to get to that next level. And it looks as though video is going to be a huge part of that.
I'm sorry, Alex, didn't all of Hollywood literally just go on strike over this? Didn't we have actors and writers walking out? Did we not solve parts of this already?
Crucially, yeah, the actors and the writers went out on strike, but the studios themselves are the ones negotiating this part. Now, obviously, as you said, there are two studios that seem not to be that interested in doing it. Perhaps, of course, Disney and Netflix with a slightly stronger, tech backbone, as it were, than some of the others. Perhaps they have more of those capabilities in-house. It'd be interesting to see, though, how they square that essentially. The deals they've signed with the unions compared to the deals that they may well sign with Silicon Valley, and it looks like a tough one to square away.
We do have OpenAI striking this deal to license news from News Corp. What do you make of that? Is that potentially a model that other companies can follow?
It certainly looks like it. I'm really interested to know what the details are of these kind of deals, because there is a view that, if you think about the media industry as a whole, where it's been in many ways, the revenue streams have really been eviscerated in terms of advertising income. The web has taken up a huge amount of that. But they haven't had many improvements on the cost side. There's a theory that then AI will improve their costs by meaning they have to employ fewer people. So it might be good news for the media industry, it's terrible news for journalists, for instance, because there may not be the need for quite as many editors. So perhaps by doing this, it won't necessarily come back to bite the likes of